I did. No, can't wait. Yeah. You're gonna. I really like did there, Take the profit
That's pretty bad. Yeah. Wow.
Uh, yeah. I guess it's cut off anyway, right?
Yeah.
All right. Cool.
Waiting to see.
Right. Andy, right on time. All right, cool. Well, thank you all for coming today. I definitely appreciate you all. Welcome to Out of Our Home. I'm gonna call you all my homies, okay? I'm your host, Langston Carr, or Langston the Realtor. I have a background in education as well as marketing and engineering. I've been a realtor now for 7 years? This is my 8th year. And I will say that my first 3 years, I would call it a wash. All right. I would call it a definite wash. Like I didn't do hardly a thing. Like it's hard enough, of course, trying to motivate yourself as an entrepreneur, of course, to do certain things, but then you have life events that happen. Following my 3rd year, I started skyrocketing. Things started going pretty well. I started learning the process, learning exactly how real estate works and things, of course. And I can definitely say that I thoroughly enjoy being a realtor. I enjoy educating other individuals. I enjoy being able to see your smiling faces once you've accomplished this lifetime goal for many. And I enjoy just creating relationships. So once again, thank you all for attending today. I have a couple of different hosts with me here. Jacob E. Hall, he's with Regions Bank. I'm sure he will introduce himself just a bit later. We also have Tony Collier, who's with Frazier Insurance. Okay, so she's going to discuss Tony Frazier. Sorry about that. With Frazier Insurance, and she's going to be discussing homeowners insurance as well as other insurances, of course. We have your DJ, who is also a realtor, Chris McGee. Chris, just say hey to people.
Hey, to the people, how y'all doing?
All right, but he is also a realtor, of course, and they're all part of the home team, which stands for Home Ownership Matters. Okay, so just HOM. All right, so we're all part of a home team, as well as my assistant here, Klein Mitchell. All right, our photographer, Elliot Reese. So thank you all for attending once again. So you are here to learn exactly how to buy a home, because I'm sure that somewhere along the line you said, hey, you know what? I need to get some things together. I'm tired of paying this rent and things like that, you know, and I need to start building my own wealth, right?
Yeah.
All right. Just by show of hands, have either one of you all ever owned a home? Okay. All right. So to be a first-time home buyer, you can actually have bought a home before, but you cannot have owned a home within the last 3 years. So it doesn't matter if you bought a home in the past, of course, you become a first-time home buyer if you haven't owned a home in the last 3 years, okay? Today, we're gonna learn quite a few things. Not gonna just, you know, go down the, let's just say, the day-to-day process that Google would tell you, of course, hey, find a realtor, you know, find a lender, get approved, get your home, and so be it, all right? Buying a home is more of an individualized process, okay? It's not a process in which, you know, we can just truly give you a generalized guide. Everybody's home ownership journey is completely different. There are no two people that are alike in terms of home ownership, okay? So everybody's journey is going to be different, okay? And that's one of the reasons why I enjoy this career, because there is something that is new on a daily basis, okay? But today we are going to learn why you should buy a home, okay? And the benefits of home ownership. We're also going to learn the basics of credit. I'm sure that many people struggle with, you know, getting the credit scores right and things. Most of the times when I have people that talk to me about wanting to buy a home, like, just gotta get this credit right, gotta get this credit built up and things like that. And it's not as difficult of a process as we make it out to be, okay? I want to let you all know that you can and you will do this. It's just a matter of when, okay? We are also going to discuss the essentials of mortgage fundamentals, okay? In addition to, you know, the process of actually looking for a home. That's the enjoyable part, all right? Unless you were trying to buy a home within the last 2-3 years, it probably became a little frustrating. We had limited inventory, which means that basically people are flooding the market, you know, low interest rates and things like that. So everybody's fighting over this one home, right? So yes, it was a difficult time to actually buy a home. More than likely, we're paying over the asking price. And I will say that an asking price, and I want you all to get this out of your heads as well. An asking price is strictly a marketing price, okay? Strictly a marketing price, all right? It doesn't mean that like that's what the seller is going to accept. It doesn't mean that, you know, you make that offer, of course, for the asking price and like, hey, you're gonna get that home, especially if other people are competing for that same home, all right? I will say that we are slowly turning the market. There is a shift, okay? And that shift is becoming more of a buyer's market, all right? Which, you know, can definitely be advantageous for you all as home buyers. I will also say that right now is the best time to buy a home. I'm sure you all hear that pretty often. It's not really just a marketing thing or anything like that at all, okay? At the end of the day, home prices really just don't drop. You know, You may see some incremental, decreases and things like that. But more than likely, that's from the aspect of like, they had their home a little overpriced, or the home just isn't actually selling right now. It doesn't mean that the value of that home isn't what the market price actually was, okay? But it does mean that, like, I honestly just forgot my thought there. But needless to say, when you're looking at these prices on Zillow or Trulia or Redfin or whatever it may be, disregard that, okay? Just disregard it, all right? Now, that being said, also, you don't want to get into the market where you're trying to offer, 50,000, 30,000, things like that below the asking price. More than likely, it's not going to happen either, okay? It's still a highly competitive market, but it's competitive right now in terms of rates and things of that nature, okay? We're going to start seeing this shift, coming to fruition, probably about the turn of the season. Again, right now is the best time to buy a home. We're going to learn how to calculate your home's affordability, okay? Basically, what you can actually pay for, all right? What you can actually afford. We're going to learn about comparing financing options. We're going to learn about how to obtain an actual mortgage. We're going to learn about the loan approval process, and we're going to learn about preparing for the closing of your actual home, okay? Are there any questions or concerns or anything like that before I actually begin? All right. If I am speaking a little too fast or anything like that, please just kindly raise your hand and things, and I'll try to slow down for you guys and get these other things away.
Two short questions,
Okay.
actually. So you said you were in engineering.
Yes.
What type of engineering?
So it was I worked for the highway department for quite a while. Environmental engineering.
Okay.
So we did a lot of things in terms of really, obviously, widening roads, preparing for the landscape of the roads and things of that nature. A lot of Title VI, information, things of that nature, of course. It was really a lot of environmental engineering.
Okay.
Yeah.
I only asked because I used to work on the education side of
Really?
engineering, so I like to know what kind of engineering.
Well, the education side of engineering is something I actually taught. So I did teach, it was 7th and 8th grade, but I taught, automation, robotics, green architecture, design and modeling, and computer science. So different formats of engineering, of course, but the general basics of it.
Okay. The other question I had is a question. Yeah, I guess it's a question. So you said first home owners, it's like you can apply or become a first home owner after 3 years of ownership of
You don't apply for it or anything like that, but you automatically become a first time buyer if you haven't owned a home within the last 3 years.
Within the last 3 years.
So let's just say you got divorced or something of that nature, you moved into an apartment and things because finances and things changed, and you didn't own a home for the next 3 years or so. Once you buy a home again, of course, you become a first time home buyer.
So is anyone using that, like people who invest in real estate, do they use that or are they able to use that?
Investing in real estate is completely different.
Uh-huh.
It's honestly a completely different process. There are different down payment ramifications and things like that, of course. So it's looked at completely different.
Okay.
And I mean, I could be wrong, but like Jacob is, am I correct in that?
No, you're correct. So, investing, you're retaining the property. So even if it's in your name or LLC, that's still considered ownership. So even if you don't live in it for 3 years, you're not a first time home buyer because you still have ownership in a home.
Okay, because I was thinking,
Good try.
something like that, I could see it being like that. Just seems like like, oh man, I can get all those benefits again in 3 years.
Now, I mean, and we can get into all of that, of course, on a one-on-one basis and things, but I will say, like, you can look this up, of course, but you can be a first-time home buyer and invest all in the same realm. It's more of a term we call house hacking in a sense. So let's just say, for instance, you did own a duplex or a triplex or something of that nature. You can, buy the entire complex, obviously live in one side, rent out the other sides, and have basically your mortgage paid for while, possibly collecting some additional on the side.
Mm-hmm.
Yeah.
Okay.
All right, so first things first, we have a little icebreaker. Now, I was expecting a little more people signed up, obviously, oh, my bad. Gotta do that, yeah. A little icebreaker, of course, to get to know one another. It may be a little difficult because it is bingo, and we may not have enough people, of course, here and now to play this, okay? Klein, if you pass these out. And I guess just so that, we will have enough people, I'm gonna get everybody to play, including ourselves, of course, okay? Now, I will say that this isn't the typical bingo. I'm not gonna just call out, the squares or anything that's on the sheet. This is more of you're gonna have to get up, you're gonna have to, of course, talk to each other in order to actually fill out your squares, okay? Just like the typical bingo, you have 5 blocks going horizontal, 5 blocks going vertical, and then of course, you can connect 5 blocks diagonal. And you have a free square in the middle, which is for home ownership. What? Matters. All right, thank you. All right, we have our free square in the middle for home ownership matters, okay? All right, so I'm gonna give you about 5 minutes or so to complete this. Obviously, I'm afraid that everybody in this room, of course, has the ability to read. So we are going to go from person to person and basically ask these questions. And if there's another individual that has completed one of these tasks, we're just gonna sign off on that, okay? Until one person gets, 5 going straight across, 5 going up and down, or 5 going diagonal. Okay, any questions? No questions. All right.
Yes.
So let me put the timer on here. I believe it is shipping T.
5.
Or is it? Uh-oh, nope, that didn't work. Hold on. Yeah, that didn't work. I know that there's a timer on this thing.
On the,
Siri, start at 5 minutes.
yeah,
Yeah.
it's my alarm.
But
All right.
you start at 1.
All right, cool. All right, Chris, DJ Chris Beast. All right, we're gonna go ahead and start now. You got 5 minutes to complete these tasks, okay?
All the ones that.
Ask people which one we want.
I don't know where you're doing.
Sure, you're the first time. All right, let's find out on it.
You're a realist, I need you.
I have the same as yesterday, actually. You say like,
Okay.
Let's see here.
Yeah. And what did you do? Chris, Cassandra. I can even bring home. My first day.
You know.
He talked to you before. But I do want to bag you up. He didn't tell you though. The bag first.
Cool.
Or do you have?
Lots of sound.
Have you researched today?
Tell me what you want to know.
What's? I'm just writing. I mean, technically.
I do have it.
Have you checked today? Only person that can help me.
All right.
So, what you got going on today?
Which one is trying to?
Almost.
All right. Got you. Hello.
I bring up a phone with a little. Okay.
Yeah, we can do more than one person. We don't have no people to do.
Bingo. Bingo.
You got bingo?
Yes.
I didn't know, I didn't realize you get from anyone from this person.
I forgot to ask you.
Because I could have been.
That's all right. I know that. That there, really, I'll bring it.
Right.
You went to that everything.
I'm the.
Oh,
You gotta keep.
You got your bingo.
Once a year.
Hey, wow, cause some always be like, right.
right, it's time.
Four people.
All right, so we have bingo. Okay, your name again, it was Keith.
Shay.
Shay, okay. All right, so Shay has bingo. Shay, tell us what row, or what diagonal is.
I went
they in?
straight across.
Straight across? Okay,
The assistant, she has a specific neighborhood in mind.
okay,
Miss Tiffany wants a new home, and then I have home as my free space.
okay,
Then Langston has begun saving for a home. And the region, I forgot his name.
Jacob?
Jacob knows what DTI stands for.
Okay, good deal, good deal. Does anybody in this room know what DTI stands for? Okay,
I do know. I did know, I just don't know the acronym.
okay. Well, there are a ton of acronyms in home ownership, okay? And DTI actually stands for debt to income, okay? And it's one of the ways that a lender is going to look at your qualifications, of course, in order to see how much you may actually qualify for with a mortgage, okay? All right, so Shay, since you are our winner, see you are, great, do a prize for you, okay?
Dude.
All right, good deal. All right, so, all right, so you are thinking about buying a home. Just give me a rundown on why you want to go ahead and start this process. April, if you don't mind?
Ownership, legacy, something to hold on to. I mean, rent just goes down the drain after, I just want something to call my own. Something
Okay.
I can pass down, something I can sell, something that I have control over.
All right, makes sense, Cassandra?
A lot of ditto. So I can say I also want ownership of my own space. So I've been a long-term renter in apartments more so. Which some have given me the space, some haven't, some have some restrictions I don't want to deal with.
Okay,
Especially when it comes to maintaining the home. So you kind of get a lot of crapshoot when you rent of who your owner is and how much they even care about their own property. So,
makes sense.
but yeah.
Okay. Tiff?
We are past our time in our apartment. There's no other quality apartments in the area that I like.
It's time.
And so it's time.
Okay.
Now,
Shay?
I agree with everything. I think it's beyond time. It's just, I think now my lease is up in March. I'm already paying $900. They're trying to go up again, $60. We ain't got no space, so what y'all keep going up for? It's time.
Well, I mean, and as a landlord myself, I can also speak on the fact that, like, I know, of course, as a renter, of course, you look at certain things in different lights. As a landlord, we look at certain things in different lights as well. And there are reasons as to why, to justify, of course, going up on rents and things. But one of the benefits, of course, about home ownership is most people, okay, not all, but most people, when they are applying for a mortgage, they're, of course, applying for a fixed mortgage or fixed rate, okay? Which means that basically the levels stay the same, all right? All right. 30 years from now, I'd imagine that your $900 rent, of course, would more than likely be about 2,500, okay? More than likely, all right? But, you know, if you were to buy a home and your mortgage was, you know, 900 or 1,500 or so, 30 years from now, guess what? It'll be the same. The only thing that generally changes, of course, or can change, is your taxes, all right? Property taxes can increase and fluctuate things, okay? Depending on the improvement of the area, things like that, of course, as well as your insurances, okay? So homeowners insurance, depending on how many claims you filed, or, you know, obviously we've had quite a few storms in the past year, right? Things of that nature, of course, affect your mortgage rates, things of that nature, okay? All right.
Mortgage payment.
Mortgage payment, sorry about that.
All right.
All right. But congratulations on making this decision and buying a home. Yeah, he definitely checking. But congratulations on making this decision to buy a home. It is one of the, like I said before, one of the most joyous occasions in most people's lifetimes, of course. But that is not to say that home ownership does not come along with work. It does, okay? It comes along with work. All right. As a renter, most of the things are taken care of for you. You know, if the AC goes out, guess what? Boom. If you have a good landlord, those things are going to be taken care of for you. You know, as a homeowner, guess what? You got to take care of yourself. Okay. But in most cases, you'll have insurance, right? In order to hopefully take care of some of those things for you. Unless you're just one of those people that just make claims on every single thing. Okay. You might get insurance canceled. All right. We don't want that to happen for you. Okay. All right. But want you all to make the right choice, of course, when you're buying a home. And so that's some of the things we're going to talk about here today. Historically speaking, home ownership is one of the first steps to financial wealth, okay, or financial freedom, okay. Like you said before, you know, it is a part of, you know, leaving somewhat of a legacy in a sense, okay. I want you to not look at homeownership as, you know, this additional expense. And I will say, not to bust anybody's bubbles or anything like that at all, but the likelihood of you, you know, getting a mortgage that is going to be like, at this day and time, it's going to be under like $900 is going to be slim, okay? It's not to say that it's, you know, it can't be found or anything like that at all, but it's going to be slim, okay? Home prices obviously have increased over the last 3 years, okay? Home prices increase on a yearly basis anyway, but generally speaking, they increase at a rate of between 3 and 5%, okay? So just to keep numbers simple, if you were buying a $100,000 home, next year or historically, the following year, that home would be worth about $103,000 to $105,000, okay? And the year after that, it would be worth, you know, somewhere between $107,000 and $111,000, and so on and so forth, while you're continuing to pay, you know, that mortgage off, okay? So you have this gap that we call equity, okay, which is essentially your funds, okay, your money, all right? So the benefit of it, obviously, is you're not just throwing this money, you know, down the drain, okay? So I want you to look at it as a forced savings account, okay? You can utilize these funds for other things in life. You want to start a business, you can borrow against, you know, your home, of course, in order to do so. Because it then basically becomes a, what's the term I'm looking for? Not necessarily equity, essentially, yeah, collateral, basically, yeah. It becomes collateral, you know? So you can utilize it, of course, because like, you know, like, hey, okay, what do you got? I don't have any cash, but I have this house right here. If, like, by default on this, I guess basically you can take my house, you know? So obviously you don't want to do that, you know? But if you're a responsible individual, of course, then yes, you can do certain things like that. Or in most cases, what people do, because one of the most difficult tasks is coming up with these funds for down payments and things of that nature, okay? When you're moving into your second and third home, a lot of times what people do is they take this equity that we've now built up and basically flip it over into our next home, okay? And essentially you continue to, you know, increase and things like that until we get into our geriatric years or our empty nest years and things, and we start downsizing, okay? And then, of course, you generally have a lot more money that you can utilize, right? So, again, I want you all to Not look at, this mortgage payment as being, significantly more than what your rent is, but look at it as a forced savings account, okay? All right. The benefits of buying a home, of course, as I said before, as your property value increases, you'll learn that you'll start building long-term wealth, okay? Obviously, the longer you stay into a home, the more equity you build. Now, what has happened over the last, 2-3 years post-COVID, this 3 to 5% equity that generally or historically has, taken place on a year-to-year basis has been roughly about 23 to 24%, okay? If you bought a home in the last 3 years, then, you've had the benefit of basically really just gaining a lot of equity in a very, very short time. All right. In most cases, when people buy a home, they're not able to actually sell the same year without, taking a little bit of a loss. So, okay. And that's primarily because, you haven't built enough equity for it. But what we've seen within the last couple of years, of course, is people that bought a home, sold the home in the same year, still was able to walk away with some funds in their pockets. All right. Now, this is taking place not just here in Arkansas, it's taking place pretty much all over the country. Okay. This equity, like if you bought that $100,000 home, end of the year is about worth $120,000, $123,000, whatever it may be. Okay. As I said before, though, we're going to start seeing, this transition. Okay. And a lot of things, a ton of things, and I'm sure that Jacob can speak on this as well, have to do with the economy. Okay. A lot of things have to do with the economy. So more than likely, feds are going to continue to spike this rate until, we get to a point to where we're probably about 2% on the, what's the term I'm looking for here? Basically, let me just disregard that because it'll come back up to me, okay? But they're going to continue to spike the rates, of course, until we can get back to a normalized market, okay? So until that time actually comes, of course, you're going to see, spiked interest rates. But when we see spiked interest rates, that is still a good time to buy a home, because if you've tried to buy a home within the last couple of years, you're not really able to negotiate anything at all. It's like, look, this is what you got. You want it or not, take it or leave it, right? The only thing that affects home prices, for the most part, the only thing that affects home prices is inventory, okay? Is inventory. And this lack of inventory that we've had over a couple of years, of course, has caused this spike, okay? And then it didn't help that interest rates were extremely low, because you have like a flood of people that are attempting to, buy. But things kind of slow down once interest rates increase, and then more inventory comes about, of course, and more inventory that comes about, and the less people that are willing to buy basically creates a buyer's market, okay? All right, so the first step in home ownership, honestly, is believing that you can do it, okay? Pretty much everything in life starts at belief, all right? You have to believe that you can actually do this thing, okay? So again, it's not a matter of if you can do it. It's not a matter of if you will do it. It's a matter of when, okay? And you can start this process right here, right now, today, all right? One of the next steps, of course, is learning about the process. And obviously you believe that you can do this process because you are here today learning about this actual process of home ownership, okay? And then the third thing to do, of course, is gather a trusted team, all right? We have a team of individuals here right now today that are more than willing to assist you all with this process, all right? As you're going through this process, it's likely that you have a lack of knowledge, all right? Now we do this on a daily and a routine basis. This process can and will be a bit overwhelming for most people, okay? It will cause some anxiety. basically from the lack of knowledge and from the overwhelming aspect of things, of course, right? But again, if you gather a team of trusted individuals, these individuals will take your hand and guide you, okay? They'll guide you through this process so that you can feel competent, so that you can feel confident, so that you can feel accomplished, and so that you don't just feel sold, okay? I don't think anybody likes to feel sold on anything, right? You don't want to feel sold on something. You don't want a lender that's going to say, hey, okay, here's the paperwork, sign here, sign here, sign here. All right, what does this paperwork mean? I don't know what any of it means, okay? I've had that happen to me. I don't like it, okay? One of the reasons that I work with the people that I work with is because I know that those people will actually guide you, okay? I know that those individuals will actually educate you. I know that those individuals will leave you feeling confident and comfortable with your process, okay? If you gather a team of trusted individuals, of course, you will feel competent, confident, and be able to walk into your home with some excitement, okay? All right, so now we're going to talk about the essentials of mortgage, okay? So we have Jacob E. Hall here, and he's going to introduce himself and take on this process.
Good morning, everybody.
Right.
All right, we are up and at 'em. Cool, so just a little bit about myself. Been in banking for 16 years. I've been in mortgage for the last 7 of those years, starting in 2016. So I've seen pretty much everything that you can name, the good, bad, and the ugly. So I'm just here to share my knowledge and expertise with y'all in order to be a resource and to help you get into your first home. And starting with that, how much home can I afford? My usual conversation when someone calls me or I'm allowed to call them by contact, basically I ask them, what are you comfortable paying? What are you currently paying right now? You stated that you're currently paying $900 in monthly rent. Do you feel comfortable increasing that in order to find something, or are we working within that $900 to find you something as well? So we come up with a team approach to find what fits best for your needs. Some people have budgeted for more, like, hey, 900 is cool, but I can stretch to 1,200 if need be, if we find the right house. So my number one question is, what do you feel comfortable with? Instead of, hey, this is how much you qualify for. But some people want to know that maximum number, and I can calculate that. Basically, it's just a myriad of numbers and formulas that I'm going through. I'm taking your gross monthly income, which is just, let's say you get paid hourly, and I take your hourly rate times 40 hours a week, times 52 weeks a year. So basically, that gives me your gross income annually. I divide that by 12, that's your gross income monthly. Then from that, I multiply it by a maximum debt to income ratio. We'll get to that a little later. Usually it's 50%. Can't go over 50% of your gross monthly income for all debts that you have. So let's say that you have a $500 car note and $200 in credit card payments. That's 700 right there that I have to set aside. And I subtract that from the 50% to give you how much maximum mortgage you can afford. So we'll get to that here in just a little bit with some calculators that we'll look at. So I look at your assets, credit, and income. Those are just the 3 basic areas. So where your assets, meaning how much do you have available to purchase a home? Do you have money in a checking account, savings account, 401k, gift from family member? Do we have down payment assistance, some type of grant funds to help you with the assets of closing on the home? Because you're not always going to get into a home just for free. It may require something out of pocket because there are what's called closing costs, prepaids, down payment. We'll talk about a couple other things later. Your credit. Your credit is one of the main factors that I look at, and basically qualifying you for different types of loans, and also how much you can afford or qualify depends on the loan type, which also depends on the credit score as well. So looking at your credit and the history of credit, are there any collections, any negative reporting items? Do you just have a lack of credit? Some people have never used credit before. And so where there are some loan options available for that, to where you can use things called alternate trade lines or alternate forms of credit, to where you've paid 12 months on your Comcast bill, 12 months of car insurance, 12 months of rent, And it's usually 3 to 4 items that we look at, and let's say 12 months of a cell phone bill. So you take that history and create what we call alternate trade lines. Next, we talk about your income. Is your income stable? That's a real big thing now with underwriting. Fannie Mae and Freddie Mac and FHA and the government sponsored entities, they've taken a deep dive into, does your income vary at all? Most people work 40-hour work week regularly, and that's consistent. But let's say that you had to take off work for a medical emergency or family emergency. There has to be some type of reasoning as to why your year to date does not match that 40 hours a week. So we're taking a deep dive into your income to make sure it's consistent, because we don't want to be responsible in the event that you close on the home and then you get into a tight spot with your income, that you're not able to get yourself out of that by paying your monthly mortgage and your other liabilities too. So we look at your income, salary, basically you're going to get paid, what you get paid annually, regardless of how many hours you work. But really, the number of hours is scrutinized a lot. Also, with any type of outside employment, let's say that you have a part-time job. You have to have a part-time job 2 full years in order to qualify with that income as well. So a full 2-year history of holding down a primary job and a part-time job with no gaps in employment. That's a huge thing that we look at too. Any gaps in employment in excess of 30 days, we ask for the explanation of that as well. And so we basically have to understand your income situation to qualify you. I think that's all I have right now for income. You got any? Nope. Okay. Next is, how much do I need for a down payment? A variety of flexible programs are available to borrowers today to make down payments less daunting. You may be able to buy with little or no down payment if you qualify. It's important to know that most lenders will require you to have funds equal to 1 to 3 months housing costs available, that we basically call reserves. So there is, let's just say this, a loan is a risk for a bank and for you too. So someone with a lower credit score is going to maybe have to come out of pocket or put a little skin in the game in order to obtain that mortgage. Someone with a higher credit score can come less out of pocket because they're less of a risk. See how that works? Basically, it's just a counterbalance or whatever you call it. And basically, I have an option here at Regions that I can do no down payment, no PMI. We'll get to PMI later and tell you what that's about. But with no down payment, no PMI, with a 680 minimum credit score. So that means you're literally just walking into the house with no down payment. I can finance the entire purchase price. It just does require at least a 1% investment of your funds. So let's say a $200,000 house, you pay $2,000 of your closing costs, and Langston negotiates the other 3,000 to 4,000 out of the seller, and you can walk into a home with no down payment. But it has to fit your situation, assets, credit, and income wise for that.
All right, real quick. You're right there.
Can I go back?
I think if you go to the left side of the screen. So.
Okay. There's a worksheet called.
So you all each have in your folders, of course, this packet here. If you flip past the intro page, of course, you will see calculating your gross monthly income as well as calculating your debt. Okay. I want to take a few minutes for you all to complete this information so that we can kind of figure out, or you can figure out approximately what your affordability actually may be. Okay. So let's get about 10 minutes or so on this pass. What you're going to do is you're going to write down all of your income that you actually filed on taxes. Okay. So no side money or anything like that. I don't know if you
All right, hairdresser.
sell dolls, something like that or whatever. You're probably not you're probably not filing it on your taxes. Okay. If you do braids and things like that on the side, you're just collecting cash, or you're a promoter,
Cutting yards.
right? What you say?
Cutting yards.
Yeah, cutting yards and things like that, of course. Anything that you're just pocketing the funds and you're not turning it into Uncle Sam doesn't know you make it. okay? So we can't use those funds, okay? So I want you all to write down the funds that you actually have filed on your taxes, okay? And then from that next page, I want you all to write down your debts, okay? The secured debts, right?
Any debt, so your monthly credit card payments, your student loan payments, your car payments, anything that you're co-signing on with anyone, those payments are under you as well. Even if you're an authorized user on an account, I have to calculate that payment in your debt to income ratio too.
Now, what we're not looking for at that is like what your utility bills is, right? We're not looking for how much you pay for cable and things like that, or how much you may spend on a monthly basis for clothing and things like that. We don't care about that stuff. Those things can adjust, okay? But the things that you're required to pay, we're looking at those things. So if you have a credit card and your credit card balance, let's just say it's $3,000, we're not looking at the fact that you have $3,000 worth of debt right now. Mortgage is looked at on a monthly basis, okay? So we're looking at the minimum payments that you have on those debts, okay? So if that $3,000 credit card, your minimum payment is $25, I want you to write down that that debt is $25, okay? Make sense?
Must be on a promo or something, because that ain't no normal payment for the $3,000 balance. I'm at it. I can't. I can tell there's something that's on the promo balance. Looking at your credit report, I can tell a number of things. Shows me actually the last 24 months of history on the credit card. I can tell December of 22, what you paid on that credit card. It tells the whole story.
All right, so does
So
that make
raise your
sense?
hand, raise your hand if you need any help calculating. I'll come around to you.
You do a worksheet on
What's the title of this worksheet, please?
So this is the first worksheet is calculating your gross monthly income. The second worksheet is calculating your debts. And then the third pretty much is where we can get around to like approximately how much you can actually afford, okay?
We may need that 15.
Okay.
And again, holler at me if you need help.
Turn it up. Excuse me, Mr. Carter. Mr. Carter.
That's how I have to do it. So we got to go to years, dollars, and your state. For your business. So we'll have.
You count everything, okay. Yeah, I do
Together. We get the business. So now I just. Hey, Jake, are you guys projecting similar? No. Well, we could try.
So when you make like 5 weeks. So what you can get for per week, you calculate for the month. 8, 2 weeks. Oh, some people don't.
And how long have you been employed? We will have to take a look at it. The last 2 years.
Yes. Thank you.
You're welcome.
Look at mine. It shows me that I'm not on. These are all that's all.
Excuse me, Mr. Carter.
And it refreshes.
Yeah.
I mean, it has like all my spot card on this, so that's in here now.
Well, Credit Karma is. It's pretty, yeah, it's got. Yeah, so, being for as long as I could, it was thinking of that mentioning for that. Okay.
Then one might, is the same personal, and then 25% off.
That's interesting, they are.
But I business owner, less than 25%. 25%. Fine. People think it's atrocious, but like, what the fuck is kind of that concern?
Yeah. It's a business. You know, but if we got our executive use to substantiate.
But they want to make sure.
Everybody
that benefits as long ain't making the same
and
throughout the years. Some people don't grow, some people decline. More than a 20% decline in a 2-year span, then it's not the worst thing ever.
if nobody really does their job, I'm pretty much guaranteed.
During all stuff you talk about.
Insurance never suffered. I don't know any, so it's some insurance agents. Just that, you know.
We just go down all the floors.
So we could do an office, you know, how to have like, you know. I didn't have.
Exactly.
Or, I don't think that you can collaborate. I don't think you can. The one thing would you call that? You know, there's a lot of mistakes that you can make in insurance. And harder mistakes can be detrimental.
Sure.
And I don't think you have that layer of training and all that. I mean, it's only,
You could play it.
we do a hybrid. But I just don't feel like an interaction. That productivity is down. Not getting up and down, doing the things, you don't have, you roll out of bed. Instead of getting up there, right? 5 minutes at a time to move the log on, and I can tell, I'm like, I got the camera on there. But. And stats are in, guys.
Thanks, sir.
Not
Yes, sir.
favorable for this to continue, you know. Rather than politics. They come in. Yeah.
Y'all ain't made that.
It's in conference room and then another workout room. The couch in it, so I had kids set up and.
Or anything? Okay. Okay.
So once you all have your actual income figured out and your debt figured out, we'll go through the affordability together, okay? Hey, David, it's the income before taxes, right? Correct. Yes. Yeah, it goes. No, yeah. If you got the income, it's the income before tax.
So if you make $20 an hour, how I calculate that is 20 times 40 hours a week, times 52 weeks a year, 41,600 gross, divided by 12 months in a year. That comes to $3,466.57 for gross monthly income.
You put down, any loans that have been deferred as well, right? So if you haven't paid student loans,
Correct. So if you don't have a monthly payment on your student loan, we still have to calculate like a monthly minimum depending on what loan type. So let's say that you have $100,000 in student loans. If we're doing a conventional loan, I have 1% of that. If we're doing an FHA or like a government loan, 10%. So if you have $100,000 in student loans, you're counting 1,000 against you or 5 against you, even if you're on an income-based repayment. That is the change. because a lot of people were getting away with income-based repayments, reporting a low income, and you get zero payment. But I would not qualify you on the same income. So, they would-
That's the way you were.
No.
What did you
Jacob, so from a monthly perspective on the nothing to talk about, how, you're third right now, but I don't know exactly, but round it out.
Let's apply by half, say, 400 a month.
Hey.
Hand down that. It's not.
All right, everyone has their total growth monthly and the sum of your total monthly debt. Correct? We all good?
Yes, sir. You good?
Everyone has their gross monthly income number
All right.
and then their total monthly debt obligation number. Got it. All right, so on the worksheet 3, calculating your maximum mortgage payment and mortgage amount. So there's two different ratios, debt to income ratios that we look at sometimes. Most typically, we're just looking at the total debt to income ratio. But some programs, especially those that have little to no down payment, want to make sure that they're not giving you too much housing expense ratio, which is strictly just that mortgage payment divided by your gross monthly income. So if you take your gross monthly income, put from worksheet number 1, put that on the top line and multiply that by 0.33. You'll get your maximum monthly mortgage that you can qualify for. So let's say that it was, let's say 3,000 gross monthly income times 0.33, that's 990. So that's the maximum housing expense ratio. Some programs like rural development, they actually calculate even lower than that. And they're the lowest one that I've seen is 29% of your housing expense ratio. So
What you said, no?
rural development, that's 990. So total, and of course, I'm not going to ask y'all to give your personal numbers. That's why I'm just giving hypothetical numbers up here for the board. So total debt ratio is all your bills together. So let's say that same 3,000 times 0.45.
is $1,350.
Okay.
Minus current monthly debts, so I would take that 1,350 minus, let's say you have. So you had a good old Challenger car note, that's all you had for $650 a month. That's $700. So if we were doing those little to no down payment options, to where I could technically afford you up to $990 on the front end, your back end actually limits you to even lower at $700 a month with that $650 car payment. Do y'all see how important car payments are to your debt to income ratio when qualifying for a house? They can totally knock you out of the running. Please do not buy a car before you buy a house. The goal is a house first. And that's how that pretty much works there. I think that's the end of the worksheets.
Okay.
How much do you need for a down payment? Different loans have different options. Like I said, there's a no down payment option with, I have an affordable in-house deal with no down payment, no PMI. If you are VA eligible, if you ever served in the armed forces, then you can use your VA eligibility for no down payment there. Rural development also allows for no down payment. That's where you could buy a house in a specific area that's considered rural development eligible. And so those are the usual no down payment options. And then you get into FHA, which has a minimum 3.5% payment, 3.5 minimum down payment required for that. Some conventional loan options for first time home buyers allow you to do as little as 3% down. The normal deal, if you're not a first time home buyer, for conventional, they're going to require 5% minimum down payment. So those are the usual options. And then where you can use those city funds or grants or down payment assistance to help cover that down payment as well. Anything else on down payment side? All right. How much home you can afford? We talked about, oh, I'm sorry, I went the wrong way. How important is your credit? So here's my little spiel. As being a banker, there is no quick fix to fixing your credit. These people that claim to fix your credit scores, improve your credit scores, I don't believe them at all. Because think of credit as the same as your GPA when you're back in school. If you had a couple of D's and C's on your GPA, it takes a lot to pull that up. It takes a lot of A's and B's to pull those up. So same thing with credit. If you had some detrimental items happen to you previously, clean that up, get that rectified, pay off certain collections if they're yours. If they're not yours legitimately, then go ahead and dispute them. But if they're a bill that you just neglected to pay and it turned into a collection, my recommendation is that you pay them off and get in the good with that moving forward. And then creating positive credit history with what we call savings secured loans and savings secured credit cards, which means an unsecured debt is basically someone just, hey, you're borrowing $10,000 from me, I promise to pay it back. With bad credit, that's not necessarily the option that you're going to get. You're going to maybe have to do a secured credit option to where you put up the collateral first and then turn around and borrow that. So when you get a secured credit card, that's basically meaning, let's say you put $500 in the bank, they freeze that $500 and give you the credit card for $500 availability. You show good history with using that, only 30% debt utilization over the next 12 months or so, and they usually release that $500 back to you, and you've moved up to an unsecured credit card. Same thing with an installment loan. Also on credit, secured or revolving and installment debts are two different types of debt. So let's say a credit card, you use that monthly balance, pay it down over and over and over the next 12 months. Installment debt is giving you one lump sum at one time, and you pay that in equal monthly installments. So those are two different ways to use credit, and you need both of those in order to get a good credit standing. I've never seen a credit score over 700 without having a credit card. I've just never, ever seen it before. Credit card is necessary. Even though some people hate them or are scared of them, they're necessary. Did I scare y'all too much there? Once again.
Is there a certain amount of credit cards that you wanna have, like, what, just one good one, or two or three, or how many is too many?
Good job, good question. So usually I recommend not having more than 2 to 3 credit cards per month with a balance on them reporting. I've seen people with as many as 10 open credit cards, but never have more than 2 to 3 with a balance on them. Me personally, that's my goal there, is to never have more than 2 to 3 monthly with a balance. But I have probably 10 credit cards, to be honest with you. Yep. Of course, your credit does affect your interest rate. Lower credit scores, there's a pricing grid to where we're looking at, to where risk-based, and that's all it is. So someone with a lower credit score might get a different, interest rate than someone with an 800. And there are also different factors depending on how much you put down, how much you're buying. There's a whole plethora of options that we're looking at in determining that interest rate for you. The amount you'll need for a down payment, correlating to the type of loan that you do, and then the amount of money you borrow relative to your income. FHA usually caps me at 50. Sometimes I can go up to 55% if you have a strong credit score and still get what's called an approved eligible from the underwriting system. But let's say that you have maybe the 620, some credit challenges previously, it may not let me approve you more than 40%. So there's literally times where I'm in there calculating your approval and it'll tell me, oh, they don't qualify for a $250,000 house, but maybe give them something 180-ish and it'll approve you for that. And that's all based on your credit because it's risk-based again.
Does your bank, like, so let's say if you bank with a certain bank for, 3, 4, 5, 6, 10 years, does that help you in, being able to possibly get a lower rate or get more money towards the house, or?
Not at all. Bank relationships, that's seen as like the good old boy system, does not affect your qualification because it's like, it's just not there. Yep, strictly based off of credit. And that's why they try to make it more even across the board for everyone, just basing it off of that credit score rather than relationship.
Can I still follow up on that?
Sure.
So then, what matters when you're picking a bank or a mortgage lender? If
You get a little too far ahead.
I-
The difference between a mortgage bank and a broker and all that type of stuff. Yeah. How can you improve or protect your credit? If you're not, I'll just throw this one in. If you're not actively using your credit to apply for things or do things with it, go ahead and lock it down just as a security measure. You can freeze your credit bureaus for no charge. So TransUnion, Equifax, and Experian, just give them a call and freeze it. Make sure there's no weird stuff going out there without your knowledge. But also to help improve or protect, you'll pay your bills, including any student loan debt on time. So even if Student Loan Authority hasn't contacted you yet, I recommend that you do so now because student loans are back in repayment and you need to make sure that you're on a good establishment with them. And either if you have an income-based repayment or if they need to review your file again, go ahead and be proactive and reach out to them. Pay at least the minimum amount due on your credit cards. Never do a late payment. Do not max out your credit cards. Please don't get up to that limit or over that limit because that looks really bad on your credit. Never use more than 30% of the credit line availability. So let's say you have a credit card that has $1,000 limit. Don't charge more than $300 off of that. So what comes up on your credit report that I see is your monthly ending statement cycle balance. So even though I hopefully can pay my credit cards in full every month, there's that minimum balance or that minimum payment in that balance on there at the end of the statement cycle that shows to the credit bureaus. And that's what your score is calculated off of. So if I had a wild month where I went out of country and spent $5,000 on my $10,000 credit card, that's not going to look good on my credit report for that month. My score is going to decrease. And then once I get that paid down to under 30% utilization, it may go back up.
Additionally, just for a pro tip, you want to pay your credit cards by your statement date, not necessarily by the due date. If you pay by the statement date, it'll be able to report a bit quicker. But,
Due date is actually before the statement date,
all right,
because the statement is what you just paid. So like
Okay.
one of my credit cards, well, my Apple card, it cuts off at the end of the month. So its statement date is the first of the month, but you pay it by the end of every month. So that payment that I've made by the 30th will reflect for the next statement cycle balance, showing a zero balance.
Okay.
Yeah. If I can pay them in full that month, because honestly, sometimes you may have to roll over debt from month to month, that there's nothing wrong with doing that, but I always have the goal of trying to pay it in full if possible.
Good question.
Uh-huh.
So with the credit card, if, say for instance, if I get a credit card and I say I'm just gonna spend $300 on it and I'm just gonna pay all of it, does that affect your,
That hasn't helped you a bit.
that doesn't help you at all?
Not at all. So the proper way to use a credit card, let's say with that Apple card, if it's a $300 limit, I'm gonna charge up to 30% of it, so 30% of 300. $90. I wouldn't put more than a tank of gas on that card. Let it report for that statement cycle. Pay it off in full for the next statement cycle, and then keep using it as such. That's the proper way to use a credit card. Do not close unused accounts unless you absolutely have to. When you're moving up in your credit journey, there may be some credit cards that come with an annual fee. And there's nothing wrong with that because they want that assurance or basically that little fee for giving you that availability. So if you graduate to some cards in the future that don't have an annual fee, it may be okay to close those out. The oldest credit card I had, the first credit card that I had, when I would turn 18, they started charging me an annual fee. And I was like, that's it. I'm not paying you to use your credit card when I already have these others that don't charge me to do that. And I took a significant credit hit, I think like 40 points for closing out that oldest credit card. But eventually you'll recover. Yeah. Yeah, I ain't paying you to this. You're lucky if you get my interest.
Flip side, actually, I had opened some credit cards to get like that welcome balance or whatever, that welcome reward. And so I did softly calculate because they were open less than a year. And it did just a little bit, but not any more than I've seen before when it's like those newer ones. I just ensure to keep all of my oldest ones,
Exactly.
which, yeah, I think a few years ago I did my oldest one. I should have, but it didn't have a balance or whatever, but
Yeah.
I just didn't want the account.
Yeah,
to manage all
that's
the,
one of the disassociates.
yeah, right, yeah.
City
So,
pissed me off last year, and I closed theirs. Avoid impulse buying on major purchases. Always think about your purchases, plan those, especially cars. Any type of appliances that you need to finance, any large purchases, think of those in great detail. And don't co-sign for any loans. I know they're your best friend, they're your cousin, they're your sister and your own brother. But in the event that they default, that's all you. I don't care that it's, oh, I just did it to help. No, your name is a co-obligator to that loan, so you're held just as responsible.
that's even about.
Don't do it. You can't give it to them, don't loan it to them. They're gonna give it back.
Quick, question, I'm gonna ask as an unknowledgeable person, and so on this, but if I were to, let's just say, I have that $1,000 credit card, and let's say I owe $500 on it, so I'm at 50%, on my balance right now. But let's say I call up MasterCard and they're like, hey, can I increase my credit limit? And they decide to increase it to, let's just call it $1,500 or so. Does it help me or hurt?
It helps, well, a little bit of both.
If I'm responsible.
If you're responsible, yeah, it helps you, but it also, sometimes they do a soft inquiry. Sometimes they have to do a hard inquiry to do, that credit limit increase for you, especially depending on how long you've been with them. Never more than 6 months at a time would you need to request a, limit increase.
Okay.
Yep.
I have that same question actually.
All right.
Go back, wait, I'm sorry.
Okay.
All right, so a step for you all, if you all will go ahead and, scan that QR code there. One of the steps for you all in your credit journey and in your home ownership journey is not necessarily to be concerned so much about your, credit score right now, but we want to be concerned about your credit report, okay? Bureau basically states that they rarely ever see any credit reports without any mistakes on, it, okay? Roughly about 90% of the time, there's always gonna be some form of mistake on those credit reports. So you are given 3 free times per year to, review your credit report, okay? At my, I'm sorry, it's,
Annualcreditreport.com.
annualcreditreport.com, given 3 times a year. So that QR code is going to take you to that website, okay? So go ahead and download your credit report, review it on your own, of course. We don't have to know it or anything like that, of course. But if you see anything that's on there that doesn't belong, as he said a little earlier, these are things that you can dispute, okay? And you don't necessarily have to go through a credit repair individual or anything like that in order to dispute these
You
things.
could do the work
It's a
yourself
simple letter.
for free. But you do have to dispute it with all 3 bureaus. They will have you sign in to their database. There's an option to dispute, and you'll have to wait 30 days for all 3 of them to do their research. They come back with you with a conclusion.
And you're likely gonna have to do it multiple times.
True. True. Good job. Now, it's not gonna give you the score. It's only gonna give you the credit report to show you the history. But you're making sure that there are no, obligations or errors on there that aren't yours. That's what you're looking for. All right, how large of a loan will the lender approve me for? We just went over the calculations that I'm looking for that on the maximum affordability. First, just because you're approved for 400, doesn't mean that you'll decide that that loan is right for you. Different loans have different pros and cons to them. And when I run your credit, let's say, hey, this loan may be the best for you, but here are other options to review. I always let y'all make a decision. There was a young lady, she's actually closing this week, that we looked at the options between conventional, and actually a no down payment deal versus FHA. They came pretty much neck and neck, but for some reason she went with FHA. I support your decision either way, but I give you the numbers to make the decision yourselves, to see which option is best for you in your qualification. But just because you're approved for 400,000, please don't go out there looking for a $400,000 house or even like a 410. Because we have other things to include, such as insurance. Tony and I were just talking about that. We don't want to tip the scale on that affordability and have to sacrifice on coverage or things that you're going to need down the road to look up, to look out for your best interests. Also taxes as well. There was just a recent tax assessment, reassessment in the county to where they looked at new values based on the market. And so people's taxes that I calculated, that one of the homes up on the hill here, I think in Walton Heights, I think their taxes were like $6,000 a year when I did their refinance a couple of years ago. It's now $10,000 a year. So that monthly payment increased significantly. You have to be prepared for those things in the future. We rely on debt to income ratio to determine your loan amount. We talked about that and discovered that the lender will figure and anticipate your monthly payment for your mortgage and factor it into the equation of your earnings and debt, which is what I do on a daily basis on those worksheets.
I have a question.
Sure.
The taxes you were just talking about, that's separate from your mortgage. It's not calculated into the mortgage.
It's actually calculated into. So when I'm doing a pre-qualification,
Oh,
we'll get to a screen here in just a second, but it's principal, interest, which is your obligation back to the bank, taxes, and insurance. And also another factor called mortgage insurance that we'll get to too.
but it's all one payment.
All one payment, we're just chopping it up.
So the fixed mortgage,
The fixed part of that payment is the principal and interest.
Okay.
That will never change.
okay,
But the taxes and insurance and possibly mortgage insurance, depending on the loan type, can change. What are you saying, Tony?
no, I was saying those things can definitely change.
Yeah, they can. Oh, what are closing costs? Sorry. So closing costs at the closing table, when the title of your home is passed on to you, you'll be responsible for closing costs. Closing costs normally run between 2 and 4% of the home's purchase price. Also collected at closing are prepaid amounts that you'll need to cover the current month's insurance and the next month's taxes and insurance. That is correct. So closing costs are costs for me as a lender. I'm not free. Y'all know I get a paycheck too, and the bank has a charge. So my closing costs are for me, the lender, the title company. They have costs for them to, the title company is the person that does the title search and also disperses the funds at closing to pay your first year of insurance in full. The insurance is always paid ahead, and what we calculate or collect monthly in that payment goes into an escrow account to pay it the next year ahead. So we're always ahead in insurance, but we're in arrears on taxes in Arkansas. So in Arkansas, the tax bill, which is technically due October 15th, for real estate and property taxes. And so, we collect that and actually pay the bill in April when it comes out. So, but that's actually for 22. So you pay 22 bill in 23. Yeah. Insurance, we're going ahead, so it's just, your escrow account is real fun. But there's a disclosure that'll break that down to you at closing as well. So those are closing costs. Prepaids are that first years of homeowners insurance up front. We even collect a couple of months of escrow, little cushion in your escrow account, usually 2 to 3 months on those. So if your payment or if your insurance or tax do change, it doesn't have a huge effect to that mortgage payment. So we collect a couple of months of cushion. And then also on top of that, your interest through the end of the month is collected as well, because your payment is not usually due until the month after your closing, like the month after your closing. So the young lady who's closing this Friday, October 20th, her first payment is not due until December 1st. And so you're paying the interest from the 20th until the end of October. That December 1st payment is actually taking care of the interest for November. That's on that.
Little cheat code.
Oh, here's a cheat code too. So if you close in a month that has 30 or 31 days, well, most months except February. If you close on the first of that month, there's a full 30-day cycle that we can calculate a monthly mortgage. Your payment will be due that next month. So we usually close the second or after, if you can, on a mortgage purchase.
I was always supposed to close at the end of the month, so you didn't have to pay an extra month of taxes and insurance. All these things.
So basically,
End of the
we're
month.
saying-
Close one on the first of a month, 31-day month, and their payment will be next month. I was shocked.
No, I'm not talking about the payment, I'm talking about what you have to bring to the table.
Oh, no, so
If you
that,
close on the first, you have to pay an extra month of taxes and insurance. You have to pay-
no, not quite. That's in relation to FHA. So FHA, you have to pay the entire month's interest regardless. So if you do close on the sale of a home that's financed with FHA, they recommend closing on the 31st because you would have done that whole month.
Yeah, you'll have to come to the table. If your date changes, you have to come to the table
It's
with more money.
a-
Yeah. a little bit more
We're
money.
selling the house, let's come on. Oh, buying on the buying end, it doesn't affect them.
It doesn't.
On the selling end,
Oh, okay.
FHA loan, yeah.
So essentially, you have to go through a full 30-day cycle in order for that loan, of course, to be kicked out. So if you purchase a home on the 2nd of October, again, your first payment won't be due until the 1st of December.
Correct.
If
These
you
closing
purchase-
costs, sorry, go ahead. The closing costs, is this, all of this is out of pocket?
Out of pocket, great question, because, hold on now, those. Because if you try to throw them back on top of my loan amount, that affects my loan to value in trying to finance the home. So that's why we can't lump closing costs and prepaids on top of the loan. But how he can squeeze them in is,
So, they can be negotiated for the seller to buy, to pay for, okay? And it really depends on the type of market we're in, of course, and depending on like, if there is any competition elsewhere, things. You have to understand that these are your closing costs, okay? Nobody else is responsible for them, okay? But you. Now, if they can be negotiated in, of course, great. But you also have to understand that this is an individualized game, okay? You're, buying a house from one individual, okay? So, that individual may be completely different from the next individual who may be willing to go ahead and pay for your closing costs. Now, if the seller decides not to pay for your closing costs and you don't have the funds for your closing costs, you have the funds for your down payment and things like that, If there is enough room to wiggle it within the appraised value of the home, then it can be negotiated into the purchase price of the home. But of course, again, that affects, some of your affordability in that aspect of things, okay? So, yes. So essentially, they can be financed if you don't have the funds to bring up front for it, as long as the home is
I'd like for you
valued.
to
at
have
that
all
point.
your own money, all your own money, ready to go.
Right.
But in the event that's not, there's ways that we can negotiate and make it work for you. Well, what was that down at the bottom? Some loans will allow you to finance your closing costs and on others, well, the costs will be paid by. Yep. So one of the loans that will let you kind of finance them in is rural development. I haven't done a rural development loan or USDA loan in 3 or 4 years. So I'm probably going to recommend you to someone else that does those a little more often than I do. Someone out of Saline County is who I would recommend, but because I just don't, I'm not the best knowledge about that. What does my mortgage payment include? We touched on this. Your monthly payment includes a combination of 4 elements known as PITI, principal and interest, which is just strictly the loan amount. My $200,000 loan at 7.5% interest calculated over 30 years. That's a specific amount that you pay directly, that's taken out directly and paid to the bank. Taxes are, of course, your real estate taxes owed to the county of Pulaski. There are other things in there too, like if you live in certain subdivisions, there are extra fees for, what do we call those? No, not necessarily HOA, and that's actually outside of your mortgage payment. Special improvement taxes. So some newer subdivisions have what's called special improvement taxes, which is an extra fee that you have to pay. In addition to those that we collect too. And then insurance, your homeowner's insurance, and then also mortgage insurance. Homeowner's insurance, there are 2 different options for insurance, or 2 different realms of insurance. Homeowner's insurance that Tony offers covers you in the event of any type of peril to the home, such as hail, wind, fire, earthquake. Your home is covered for that. Now, there's mortgage insurance, which is what we charge as a third-party premium in the event that you default, that we can recover on our loan. So mortgage insurance premium, or MIP, is required on an FHA loan. There's also an upfront that's thrown on top of the loan amount there. But for FHA, MIP is required. For conventional PI or not principal interest, private insurance, private mortgage insurance, PMI is required if you put less than 20% down payment on it. It's a usual rule. I have a conventional loan, but there's no down payment, no PMI. It's weird. Again, this is not for y'all to get all in the weeds. I'm just telling you what goes on behind the scenes.
I do have a question.
Sure.
Maybe.
I know I puzzled y'all with that.
So I gotta prove that it's for a loan without a mortgage.
Mortgage insurance?
Yeah, the mortgage insurance. Is that a good thing or a bad thing based on what you're saying? How are they able to offer it?
Good question. So again, going back to a loan is a risk. We're gonna offset our risk one way. So my regular conventional loan that I offer today at 7.5%, that you'll put minimum 5% down, that'll have PMI on it. I have an alternative option that will allow you to do no down payment, no PMI, but I'm gonna charge you an 8.25 interest rate. There's offsets to where it helps you come less money out of pocket.
It wasn't that high.
How long ago was it? Okay.
I just remember that mortgage.
Yeah, usually the interest rate is
Right.
higher to offset the risk of not having that PMI. We gotta make the money one way or another. Another type of home insurance that is also outside of closing is a home warranty. So that covers you in the event that the HVAC system goes out, washer, dryer, ceiling fan. It's the mechanics of your home. So there's 3 different insurances that you could potentially deal with when buying a home. So home warranty, the mechanics of a home, home insurance, the coverage of the peril or event on the home, and then also mortgage insurance or private mortgage insurance to cover me in the event. It's basically covering everybody. Y'all know that's the nature of insurance. Yes.
So is it did you say it's preferred to have all of them? Just to cover?
Like, so especially first time home buyers, like if you're just moving into your first home from being in an apartment for 20 years, you're not used to taking care of things yourself. So in the event that you come home and your home's gone with a tornado, you have to have home insurance for that. We won't go along without that. Mortgage insurance, yeah, I want to be covered in the event that you default. And then also a home warranty in the event that you have a $5,000 unexpected HVAC or home and heating and air expense that pops up. Unless you got that money saved in the bank to replace $5,000 to $7,000 air conditioning, you must have just had to do that.
I had air conditioner, stove, refrigerator, washer and dryer,
All at once?
all in the same year in like 4 or 5 months.
See, and that can happen. Revolting against you.
So home warranty insurance is going to protect you for the things, as you said before. There's an acronym called PEACH. All right, so plumbing, electrical, appliances, cooling, heating. Okay. So it's typically about somewhere in between 500 to 700 a year. And it's, of course, it doesn't renew automatically. You have to, get those things every year. So in his case, if something like that would happen, and let's just say he didn't want to self-insure and pay for all these things out of pocket himself, then that $500 to $700, depending on what coverage you have, of course, will typically cover those things.
This is, you can find insurance companies that do this in particular, or is it just, where do you find home warranty?
So that's where I come into place, basically.
Oh,
So
Use home warranty,
trust your guides.
she's home insurance. I'm automatically mortgage insurance, I'm gonna tell you.
okay.
That doesn't get past me. But when calculating your affordability, I do put in that number for expected home insurance, expected taxes. I usually calculate 1% of the purchase price as the expected taxes for home insurance, no less than $1,800 a year, depending on the age of your home as well, maybe even more.
Well, and you have to get a clearance. And the home warranty, I mean, it's not gonna cover everything, it's just not. If you have an AC unit that's 25 years old, home warranty company's gonna come in and they're gonna pay the life test. And that's a real thing. People get upset about that because they don't understand that that is a real thing. So,
Because those 25-year-old units are rarely serviceable nowadays. They don't have the parts anymore.
Yeah.
For the free on.
they're just gonna say, they're just gonna say it's what it is.
Yeah, so the warranty is not necessarily a replacement, it's more to service it, to fix it, not to provide it.
They're not gonna, I mean, if you have a 25-year-old unit that just dies and can't be fixed, they're not going to replace that.
Yeah,
The warranty company.
because you're saying
It's lived its life. I mean,
And the
Yeah,
opposite of
so-
that, if it is a newer unit and for whatever reason they can't, fix it, then yes. I will typically do that.
And so that taxes and insurance portion of your payment, we hold that in what's called your escrow account. And we pay that automatically every year for you. Every April, we pay the taxes. Every annual anniversary of your home purchase, we'll pay your insurance for you. So we just want to make sure that those are paid. Are there any special programs available to me? There are. Some banks do not participate. So there are city funds, there are grants available, there are down payment assistance options that are either federally or locally funded. Those options are out there. What I advise you as a home buyer to do is to research those on your own online, because there are websites readily available with that information of who does down payment assistance. There was actually one recently with the state of Arkansas called ADDIE. I forgot what the acronym stands for, but they actually cut it off. And so they're just revamping their program right now. So go out there to see what options are available to you before going to the lender. And on those websites, it'll actually tell you what lenders participate as well at the time.
These programs, is it just pick one, or can you qualify for multiple? Like if you get a
Some will let
grant,
you
can
stack,
you get a grant and a loan, or is it like,
some will let you stack, some will not.
Right.
Unfortunately, I'm not educated on which ones will and will not, because we do not participate at regions with the down payment assistance, since we have our own option.
gotcha.
That's what we do. Loan types. I'm taking the code. Sure. Okay.
All right, for the sake of time, we're gonna try to run through some of these, okay? But there are various different loan types, okay, that are out there for you all. The majority of those loan types are going to be either private loans or government loans, okay? So the major two loans that people end up getting, of course, are going to be a conventional loan and an FHA loan, which is Federal Housing Administration, okay? Now, conventional loan is going to be for, I'll say, and Jacob, you correct me if I'm wrong here, but a lot of times, especially in my world, of course, when you're dealing with receiving an offer, somebody has an FHA loan versus conventional loan, people tend to go along with that conventional loan because there are red lines to have to, mark through and things like that. But an FHA loan, honestly, is just as strong as a conventional loan, okay? In addition to that, FHA loans actually, as of right now, have a better rate than conventional right now.
They do. FHA is usually priced lower than conventional because of the automatic mortgage insurance that's included with it. But it really depends on your credit score as to which one works best for you.
Okay. So for a conventional loan, you're typically gonna need a 620 credit score at least in order to qualify. Conventional loans do generally have better overall payment options, like payback options rather. But FHA loans are made really to become more affordable for either first-time buyers or buyers with less actual funds to bring to the table and things. Okay, at FHA, I'm sorry, conventional loan, you can exceed certain amounts. Okay, so he's actually one of the major jumbo loan producers here in the state of Arkansas, of course, which basically exceeds what, 726,000?
726,200 is a limit every year that Fannie and Freddie said.
Okay, so those loans, of course, exceed a certain amount, which FHA basically they say, hey, you know what, you make too much money, so we're gonna go ahead and get you on this conventional loan, of course, and you're good to go. But conventional loans, of course, are basically going to assist you a bit better in the long run, long-term outlook of things, okay? A conventional loan is typically going to cover about 5% down. There are some programs in which you can get 3% conventional loans. I believe they still exist.
First-time home buyers, Fannie will let you do 3%.
Okay. So for first-time buyers, Fannie Mae will let you do 3% on a conventional loan if you qualify, okay? Again, the big key term here is if you qualify. There are certain qualification ramifications to this, okay? A conventional loan is going to have PMI, which is private mortgage insurance. As he discussed a little earlier, and we'll get into that here in a second here, but mortgage insurance is basically going to, it's put in place if you happen to default on your loan, okay? If you default on your loan, then hey, we want the insurance to, I don't necessarily have to pay it back or whatever. I'm covered now that I don't have to pay your loan back to myself, basically. Conventional loans are going to have PMI, okay? Also, as I said before, you're going to have at least a minimum credit score of a 620. Conventional loans, an advantage to it is it does have a quicker processing time than FHA. However,
the loan officer.
Yeah, I was gonna say.
Same deal in 2 weeks or less.
Yeah.
We just don't take that long.
So a loan officer is definitely going to play a major factor in the timing of everything, basically. I am dealing with a loan officer right now. We have been under contract now for since July. Since July. okay? And we still aren't closed. As a matter of fact, he tried to blame it on, the insurance, the guy that, deal with those 3 investment properties. He tried to blame it on, the insurance quote coming back later and things like that. And I'm like, no, that's not the case. He was like, yeah, we've been ready for weeks and things, and then we got the insurance binder in. All right, hey, are we set to close? No, we're not ready to close yet. I'd say, it was about Friday or so. Friday was yesterday. Hey, do we have a clear close? Nope, we don't. Cool. Like, we're still waiting to close, okay? We've been under contract since July, all right? It generally takes 30 to 45 days or so to close on a home loan, possibly even sooner, if you have, someone that can streamline the process, i.e. Jacob, okay?
The ducks in a row. So my deal is I'm pushing you to the closing table as fast as we possibly can, because that just allows me more time to do things and allows you to get on with your life. And up front, when I'm pre-qualifying you, I'll give you what's called a welcome letter. That's a list of documents that I'll need proactively: your W-2s, pay stubs, 2 months recent bank statements, copy of your driver's license. And if you're different situations, let's say you own another property or something, I'm getting your whole entire picture and tell you what I need up front. So when you're under contract and when you find that house, there's no reason for you not to have those documents ready to go. And so within that time, you're doing your home inspection, your appraisal, and that's why I get to the closing table in 2 weeks. As little as that.
If you have your ducks in a row, all right? You do
Show
have
me
to
the
have
bill
your
of
ducks.
until you're ready to buy. Till you're prepared to buy, you don't need to do it.
Correct. When you're pre-qualified, that's when the clock starts. We're ready to jump. Because you don't want to miss your opportunity on a home. You don't. I had 2 clients, both pre-qualified with me, on Monday of this week. They were both going for the same house.
I've had this situation as well. I've had clients that like, they want to put in an offer for the same house as well. And it gets a little sticky because I can't necessarily tell you, like, if both of you all, wanted to see the same exact home, and I know that this home is like, the seller is selling it for 200,000 and you want to put in an offer for 200,000 and you decide to put in an offer for, let's say, 205. I can't come back to you and say, hey, I want you to put in a little higher offer, because you have to do the same with you. Okay.
Yeah.
It'd be the opposite if, like, I was tipped off that, if you were agent, I knew that they were putting in an offer for 200, like, okay, hey, we're gonna put an offer a little higher, okay? It'd be different, okay? But as an agent, as a realtor, I do have a fiduciary agreement with you as well as you, each one of these particular clients, okay? And that fiduciary agreement is what qualified me as a realtor, okay? Not just a real estate agent. We have a certain ethics, okay? Code of ethics that we have to actually go by, okay? Now, we talked about mortgage insurance. So MI. Mortgage insurance, again, is going to basically, it's put in place for the lender, okay? It's put in place for the lender in case you happen to default on your loan. One of the advantages to a conventional loan is after you've paid this debt down at least 20% or so, your mortgage insurance can fall off, okay? You'll typically see this drop in the mortgage insurance after you've reached past 22%, okay? It'll essentially automatically fall off.
Automatically, but you can't have it manually reviewed at 20%.
Yeah. So it'll automatically fall off at 22%, but you can have it reviewed at 20%, okay? And that's 20% of the actual loan amount. So if the loan amount was 200,000, purchase price, I'm sorry. So if that purchase price was 200,000, once you've paid at least $40,000 towards that actual loan, then you'll see a decrease in your mortgage, because this mortgage insurance will then fall off, okay? And conventional loans have private mortgage insurance because, conventional loans are basically funded by private entities, okay, and not the government itself, okay? We pretty much just discussed that part right there. So government loans. All right. So government loans obviously are backed by the government. Okay. Your government loans are going to consist of your Federal Housing Administration, FHA, which is likely the most popular loan, particularly for first-time buyers, of course, or buyer with lower limits and things like that. Okay. You're also going to have your VA loans. Okay. That's for anyone that is, of course, a veteran. Okay. That served in the United States military or anything of that nature, of course, okay? And also, one of the, well, there's more loan products in this, but these are the most popular, okay? So your conventional, your FHA loans, your VA loans, and then lastly, your USDA loans, okay, which is the United States Department of Agriculture, or better known or as a rural development loan, okay? Now, rural development, well, we'll get into this here in a second. FHA loans are going to allow you a minimum credit score of a 580. And again, that depends on the lender that you're actually utilizing, okay? But there are programs out there in which you can get a loan for a 580 credit score. As he mentioned a little earlier, of course, the lower your credit score, the higher your interest rate is going to be, okay? It's just simple as that. The higher your credit score, the lower your interest rate is going to be. But in general, if you have an FHA loan, then you're going to have a 3.5% down payment, okay? Now, this down payment can't be worked into the actual cost of the house. It can't be worked into the loan amount or anything like that. It can't be paid for from someone else. Now, you can get a gift, okay? And that gift has to be from a family member or something of that nature, and it has to be written in the letter. But you can get a gift. But they want to make sure that, like, hey, I can pay this on my own, all right? And it's not coming from something like, okay, you won the lottery today and you just won $10,000 and like, hey, you know what? I got this.
We can document that though.
Yeah. But in general, they want to make sure that you can actually pay for this thing. It's not just a one-time hit, right? So,
While you're on that point there, so, you can use those down payment assistance and grant funds for that. But again, this loan is a risk. And so when I'm putting all these factors into the computer, I have to click different buttons that designates this, oh, this is out of their checking account, or this is a gift from a family member, or this is coming from down payment assistance funds. And the algorithm in which it approves you may have different outcomes depending on where that money is coming from. If it's your own money game that you have in your savings account, it's likely to say, yes, I'm cool with that because they set it up on their own. But if it's a gift or coming from down payment assistance, the computer may not approve that, depending on your credit score. Like if you got a 600 credit score and it's coming from DPA or a gift, system's likely not to accept that.
all right. So again, your FHA loans, you can have a lower credit score than a 620, which is a conventional, of course. A FHA loan, you can have a 580 credit score, but you're gonna have a higher interest rate, okay? Then we have our VA loans, as I said before. A VA loan, of course, is anybody in here veteran at all? Serve the United States military, anything like that at all? Reserves? Okay. Well, the benefit to being a veteran is you don't have to walk into the table with any money down or anything. You basically are funded 100% loan, okay? So no money down or anything like that. But there are closing costs, right?
There are closing costs and they get their money too. It's called a guaranteed fee or funding fee for them doing the loan and guarantee you, they get to throw an extra amount back on top of that.
And there are certain lenders that you definitely want to be aware of when you're, of course, getting any type of loan like this. But since nobody in here, of course, is VA, we're not going to go into all of that. Okay. But they are called origination points. All right. So you want to make sure that, like, if you happen to, let's just say, get married or something like that, and somebody is a veteran, you can't take advantage of all of that. But look into the origination points that somebody like, Veterans United or so, like just because they're, Veterans United as a mortgage lender, like that, no.
They're not the VA.
Yeah, they're not the VA at
It's
all.
a bank.
It's a
Bank
way to market
fees.
themselves. And then your USDA loan. So similar to a VA loan, a USDA loan is also 100% finance, okay? So it's basically the United States government's way of saying, hey, you know what? Let's start developing these areas outside of the city, okay? So they want to throw more funds into rural areas. There are certain areas in Central Arkansas, believe it or not, that qualify for rural development. There are parts of Alexander that qualify for rural development. Wrightsville areas. There are areas in between Jacksonville and Sherwood and things like that, that all qualify for rural development loans, okay? And again, these loans are 100% financed, so no money down or anything like that. There are qualifications that you have to meet. There are income qualifications that you have to meet. There are location qualifications that you have to meet, of course. So you can't like be in the city, you know, you have to be in a rural area. But again, there are areas here in Central Arkansas that definitely qualify for rural development, right? And what are those income qualifications?
For a family of 4 or less, it is 140, 139.
130? I think it is or 140, 138, something like that, and some change.
Yeah.
For a family of 4.
So
So
that's including all people that live in the household too. So USDA loans or RD loans get really particular about the qualification. It includes all people living in there. So if you have multi-generational family, it includes grandma, grandpa's social security and everything. So if I'm not using their income to qualify, I still gotta get a copy of what they make monthly to make sure your total household is not over that specific limit there. It gets nitty gritty.
all right. So which loan is best for you? Short answer is I don't know. Okay. This is quite frankly what it is. I am not sure. Because no two people are alike. Okay. No two situations are alike. All right. We can make the same amount of income, but have completely different debt to ratio income. I mean, debt to ratio calculations or whatever. Okay. So no two people are alike. You have a question? Okay. So it would literally take us for sitting down with you and understanding your financial journey. Okay. And that is why it is very important to go ahead and start the process as early as possible. All right. A lot of people don't want you to pull their credit and things like that because you think they're going to hurt your credit. Okay. That credit pool is about 3 points. Okay. Roughly about 3 points or so. If 3 points is going to affect you that much to say, hey, you know what, I don't need to start right now, you probably don't want to buy a house, you know? And again, going back to that first step, you have to believe in the process, okay? So go ahead and just rip the Band-Aid off, you know? If you like to start this process today, you know, then Jacob will be in the back, of course, and he can get you pre-qualified today, okay? Again, short answer is I'm not sure which program is going to be best for you. I'm not sure of your, you know, your finances or anything like that. And frankly, as a realtor, I don't have to know any of that stuff. I don't need to know your credit score. I don't need to know how much your income is or anything like that. Okay. That's not for me to know. That's for your lender to know. Okay. All I need to know is that you've been approved. All right. But I will say that, like, please, please, please don't anticipate going out to look for a home and you haven't been pre-approved. All right. Frankly, it's a very dangerous job. You know, we're meeting strangers in dark houses and stuff like that. We don't know. Obviously, I'm sure you all have heard of Beverly Carter and things like that, and know that situation that happened approximately 7 years ago this month. It happens, all right? And it happens more often than we ever know or think about, okay? So yes, please go ahead and do us all a favor and get pre-qualified so that we know that you can actually afford this home. It's not something that we're sitting here saying, okay, well, hey, I don't think you can buy it. So I'm like, no, I'm not getting ready to show you this home. It's not that. We're dealing with people's valuable assets and things like that, going to somebody's stranger's house. It's likely that somebody knock on their door today in your apartment. You know, you're not gonna just let them in, right? Okay, so, you know, why do that for somebody that we don't know any information on at all, okay? So go ahead and get pre-qualified. So a few things that you'll probably want to ask about or be knowledgeable about, at least, of course, are points.
How long does the pre-qualification last?
120 days, your credit lasts 4 months before I have to pull a fresh report.
So a few things that you'll want to compare or ask about and things like that. Ask about points. All right. And it may not be the best situation for you, of course, in order to pay those points. But when I say points, I'm speaking of your interest rate point, basically, right?
An additional cost to get a lower interest rate. So let's say I'm offering you 7.5% for free, or no discount points, or 7% at one discount point. One discount point equals 1% of your loan amount. So if you're buying let's say a $250,000 house, you're putting 50,000 down to get mortgage insurance. And you're gonna pay 200,000 as a loan amount, $2,000 to get you a 0.5% lower. The difference in that interest rate versus the $2,000 you pay to get there is basically the calculation we see if it's necessary or beneficial for you, depending on how long you're going to be in this home as well. If you're going to be in this home like 2 or 3 years and you're moving, your job tends to make you hop places or move, and you're going to sell that home, discount points may not be beneficial for you. You're just losing money by paying those discount points to negate the savings on that monthly payment. But it's a myriad of questions that I ask you to make sure it's the right fit.
Can't you beat the interest also by paying extra payment?
Yes.
Take your payment and divide it by 12, pay that extra, and you're gonna do penalties.
It's gonna be the same interest rate, but you are.
You're paying less on it, when you're
interest.
paying down on the principal, you're paying less on it.
Correct.
So essentially, like, let's just say, for instance, all right, there's 12 months in a year, you pay your mortgage, at least 12 times in a year. If you make at least one extra payment per year, then you can knock your 30-year mortgage down to roughly about 24 years, okay?
Not quite. That's the old saying, but it's not
Oh.
always that, especially with interest rates changing nowadays.
Okay.
There are interest rate calculators out there that you can see what extra payments would help you save on your monthly mortgage. I recommend bankrate.com.
It definitely does help. I mean, even adding just a little bit every month to your principal is gonna lower the amount they're charging you interest on. So you're gonna pay it off a little faster.
Additionally, I know that, if I'm not mistaken, there are still programs out there that allow 2 payments per month, right?
Bi-weekly.
Bi-weekly payments, basically, same mortgage amount, but bi-weekly payments, which then helps a bit towards the equity in your home. Right.
It does too.
That's what I
So-
was gonna ask. What's the impact then on the equity?
Yes, it helps you gain equity faster because of course it pays down the loan balance faster on a bi-weekly loan.
Is
And
the,
making extra
is
payments.
the equity building, is that like a fixed rate?
Equity is just the difference between what you owe on the home and what you basically purchase it at. So it's just paying the balance that you owe less down, paying it lower is what helps you gain more equity.
Okay.
So, as I said before, generally speaking, or historically speaking, your equity is going to build roughly 3 to 5% on a yearly basis, okay?
Your, not equity, your,
The value of the home,
the
or,
increase in value.
so, yeah, I'm sorry, yeah. So, the value of your home is going to increase roughly, historically, between 3 and 5%. Now, last 2-3 years, it just jumped, right? It jumped dramatically, like 23, 24, 25%, and in some cases, 30%, okay? But on a yearly basis, historically, it jumps roughly about 3 to 5%, depending on, the area that you're in, depending on, those things, of course. So good, basically being about 3%, decent being about 2% or so, great being about 5%, okay? So let's just take, that good area. So just to use, basic numbers here, I'm gonna say $100,000 and it increased 3%. So next year, this home is worth $103,000. I'm sorry. This home is worth $103,000. Okay. And let's just say that you put, say 10,000. Let's say you put $10,000 down. More than likely, it's not gonna be the case if you buy $100,000 home. But let's say that you put $10,000 down. Right now, you owe roughly about $90,000, and you've paid your payment for a year. I mean, you paid your monthly mortgage and stuff for a year. You'll likely owe at the end of this first year, at this point, roughly about, let's just call it about $88,000. Okay. So the end of the first year, you owe, I'm gonna say $88,000. All right. So the difference in between this is what, 15,000? Yeah, 15,000. All right. This is your equity. All right, and as each year goes by, this number increases while this number decreases.
And
Okay,
you'll reach your 20% at 20,000, because that's 20% of the loan amount when you first bought the house, right?
Yes.
Yeah, it's 20% off the loan amount.
Yeah.
The first, the
It's
100,000.
the different, it's the lesser of the two, either your purchase price or your appraised value. So he just said $100,000 house,
Yeah.
90,000 was the loan amount. So
Okay.
it's still against the 100,000.
So you still have to do it on the.
Always the purchase price.
Yeah, that's what I'm saying. I'm just assuming, yeah. So 100,000 at 20, so you're already, first year at 15,000, so you have 15,000 in equity. So next year you'll probably be that 20% equity.
not really. So
Exactly.
the
So
next
we
year,
don't-
It's up. If
We
it's
don't
gonna, the
always-
house is gonna go up.
We don't always include the, because that $100,000 is stuck in my files. We're not going out and reassessing. the
No,
value
you're
of the
not
home
gonna do it. No, you're,
Yes.
no, you can have it then. You can request.
2 years minimum on-time payments, and yes,
Yeah.
you can have requests for PMI to be removed.
so this will be an estimate for that following year, okay? So that following year, your value in that home is increased another, let's say 3%, okay? So that home is worth 107,000 now. And, you pay your payments, of course, for that year. Most of it is going towards your, interest, okay? That's why we only see it's about $3,000 drop. The overwhelming majority of it is going towards your interest, okay? So this following year, you have this difference of, well, I guess that's 22,000 or so. So now, generally speaking, a loan of this amount, you're probably gonna have an FHA loan. So just because it's 20% difference,
Necessarily.
I was just saying overwhelming majority, I guess, but I guess not. You deal with the actual
People that want to buy
loan.
$100,000 home, and they do conventional all day long.
Okay.
Loan does not, a loan type doesn't depend on how much, what home you're buying, it's just what necessarily fits you, in your financial situation.
Yeah,
At that time, I've had people that purchased a house with FHA because that's all they could get at the time. We turn around and refinance a year later because their credit has increased to over 700 and refinance with a conventional. Situations change.
and I hate that I'm using this as an example, because I don't want you to get that stuck in your head, that you're gonna go out and buy $100,000 home, all right?
Now, if you want to stay around, if you want to stay around an $800 to $900 payment, that's probably likely.
But, just, again, and I try not to speak on homes and things like that unless my opinion is asked of, okay? Because everybody's living situations can be completely different, okay? So when I go into a home with an individual that, is shopping for a home and they're interested in this particular home, unless they ask me of my personal opinion, if you ask me of my personal opinion, I'm gonna give you my personal opinion, okay? I'm gonna be completely honest with you, like, I guess for the area, the location, the home is decent, but, again, this isn't my living situation or circumstances. This is yours, all right? You have to be comfortable with that. But in general, like $100,000 homes that are turnkey ready and things like that is a unicorn, okay? It's likely not going to happen, okay? It can, but the likelihood of it, of course, is very slim, okay? But basically that's what your equity is and things like that. And, those are your funds, but, once you're ready to sell that home, then you have some additional funds that you have to come out of course, because I gotta be paid somewhere along the lines, then you have, your insurances, if you haven't paid them, they have to be paid back and things. You have a couple other things, of course, title costs and things like that. But all those things can be negotiated, okay?
Very good time to interject that on a purchase, typically the seller pays the realtor fees.
Yeah.
So you as the buyer do not pay him directly. When you go to sell your house, that pays both the listing agent who listed their house and also the buyer's agent.
Now,
Typically-
I will say this in that regard, so, things are changing, all right? Things are changing and they're changing dramatically fast,
Other
okay?
areas of the country, they do differently.
Yeah, in other countries, of course, then you as a buyer, you will be paying the buyer's agent, okay? Here in the United States, we've seen a lot of significant lawsuits within the past few months. Actually, this month and a half or so being the greatest, in which basically sellers are saying, hey, you know what, I don't want to pay for your representation, you know? I mean, and frankly, I don't really see a reason as to why they should anyway. But it's just
You
my
want to
thought.
sell your house and you brought the buyer to them, so I see.
I'm
that
paying
as-
for my representation as a person that's marketing my home.
Mm.
I don't necessarily want to pay for your representation for somebody that is, you know, showing you the home, you know, just my personal opinion.
But without you, they may have not even looked at it.
It's very true. It's very true. However, you know, as buyer, of course, you know, but you know, there are significant funds that are involved in both sides. Okay. Needless to say, again, I go back to right now is the best time to buy because I can't just say that next year that buyer's agent is going to be free throughout the United States, you know, because things are significantly changing. You know, Remax has filed a lawsuit. Coldwell Banker has filed lawsuits. Century 21 has filed lawsuits and things against, you know, the Real Association, basically. So, you know, they've all kind of broken away and separated themselves from these different organizations and entities. So we're likely going to start seeing more charges and things from a buyer's agent aspect. But as of right now, you don't have to pay for buyer representation or anything, unless there are professional fees involved, in which I do charge professional fees, but those professional fees are very, very, very minimal, for the cost of a pair of shoes, okay? And basically that's just to pay for admin work and things of that nature. So about $350. And none of that crosses hands with me or anything like that at all. They're all added into your closing costs, okay? All right, so you want to ask about your points and interest rates and things like that. Demond, you asked a little earlier, like how long does your rate last and things? And as you said before, it lasts roughly about 120 days.
Qualification lasts for 120
Sorry.
days. Now, your interest rate will change. And so when I pre-qualify you today, it might be 7.5%. When you get under contract to buy a house and say, hey, Jacob, I found a house in my dreams, it may be 8%. And so you have to be willing to still take that difference because you cannot lock in the interest rate until you find a property. That's the rule.
So there's a specific reason why it may go up a percentage or 2%. Or
Market changes every day, every single day of the week.
And throughout the day, you know.
Actually, too, yeah, there are intraday changes to where I think it was on Wednesday, they actually got worse. So someone that I quoted at 11 o'clock, by 2 o'clock, it wasn't the same. The economy changes minute by minute. So you can't lock in the interest rate and I can't promise you something until you find something.
Wow.
So as far as to when to lock in that rate or when to just float that rate and just to see how the market is going to do, that's going to be up to you. You know, now, I mean, you can depend on, you know, your unicorn lender, you know, that studies the market on a daily routine basis, but truly he can't determine what the actual, you know, the market is going to
Give
be.
you a heads up like, hey, it's 11:30, bond prices are not looking good. Do you want to go ahead and lock this in? If you're under contract that day, do you want to go ahead and lock this interest rate because they may get worse?
So it's a risk
But
that
I
you
can't
take.
tell you what they're gonna be tomorrow.
So it is a risk that you're taking, you know, they could dip. You know, you could lock it in today at, you know, 7.25, 7.5 or something like that. And tomorrow it could be a 7.25, 7%. I doubt that it drops that significant amount, of course, but, you know, just to use those examples, of course, or it could increase, you know, so it is a risk. You know, you'll just have to determine whether or not you want to go ahead and lock that rate in.
If you're
But-
a gambler or not.
Yeah,
So if you do lock it in, it drops.
Mhm.
Do you get the better rate or do you have to stick with?
You're locked. Just as if it goes up, we can't give you a higher rate, so we agreed upon that 7.5.
Which is interesting because typically it does. That's always kind of bothered me because it does, you know, most consumerism things do benefit the consumer. You know, like with your credit, like when I'm working with someone and I review credit every year to make sure that they're in, because I'll get into that, how credit affects your insurance score. But if a company, if it's gotten worse, they're not gonna increase the premium if I request it. They'll lower the premium if it gets better, because they won't increase the premium. So I'm surprised they haven't built something in for the consumer that if you lock and within like a period of time, if it does lower, then you could do it like a relock or get the benefit of that. Like some goes on sale and you pay for it, and then within 2 weeks, the price drops, you can go back to it and say, "Hey,"
The bond market and stock market doesn't quite work like that. Like,
you're not buying it until you're buying it.
like stock. Exactly, just like a stock. If you sold it at a certain deal and it goes lower, I can't go back and, let's unwind that, let's buy lower. No. You did it, you executed at a certain time period.
And those rate locks can last somewhere between 30 and 120 days as well. So if you have a lender, or let's just say the situation in which the house just isn't the best, or like the seller hasn't completed all the tasks and things like that that you all have agreed to, and you exceeded that 30 days time frame in which you were supposed to close. Closing date modifications happen all the time. All right, we were supposed to close Tuesday. Now, we're estimating to close the following week or so, and that following week gets stretched out another following week. Well, hey, guess what? Rates could have changed between them. All right.
Do you want to pay me $500 to keep this rate, or do you want to now go to the current market rate, which is 0.5% higher than it was 30 days ago when you locked in?
So why are you paying $500?
To hold that rate that I gave you 30 days ago, for me to hold it another 7 days, $500. It's a calculation. I'm just using it hypothetically.
Now I know that you're
Otherwise,
right now.
if you expire, you have to go to the next rate.
Now, undoubtedly, again, homeownership and going through this process will create some anxiety. All right. It will create some anxiety. Like, dang, I gotta have this much money up front. So it is a significant amount up front, It is a significant amount up front, but
Overall,
we're looking at the grand scheme of things.
It's worth it.
Okay.
That little chart right there.
We're looking at the grand scheme of things. This year alone, have you saved this much on your own? Just on your own. Have you saved this much on your own? Okay.
Technically,
Now-
take out the 10,000 that you put in first. So within 1 year,
Okay.
maybe potentially $5,000.
Well, this year alone, have you saved $5,000? Okay. All right. Now, if you hadn't saved it on your own, let me ask you, have you saved it without even, if you haven't saved it on your own, you definitely haven't saved it without knowing it, right? So you haven't saved it by just paying your landlord, $900, $1,200, $1,500 a month, okay? You hadn't saved that at all, okay? But again, this is your forced savings. All right, that's your forced savings account. And it continues year to year to year to year, as long as you own that home. All right. And you can roll it over into the next home, and you can roll it over into the following home, and roll it over to the following home. And that gap just continues to increase on a yearly basis. Okay. So this is a forced savings account. Don't look at it as today's picture and like how much I have to pay up front and how much, stop looking at what's right in front of you and start looking at what's ahead of you. Okay. That's what I want to encourage you all to do. All right, let's roll on through this so we can get through it. This here, Jacob has pretty much talked about the majority of this stuff, of course, but financial options that you should compare, of course, your rates, your terms, your arms and things. And Jacob, you mentioned a little earlier that the P&I doesn't change, but if you do have a adjustable rate mortgage, then yes, it does change. Adjustable rate mortgages can be, beneficial for some individuals. I know some people in this room that have definitely utilized an ARM, and it's been beneficial towards those people. But you have to be a competent and responsible individual, of course, and really educated, of course, in order to really know the market and kind of know how to utilize that adjustable rate mortgage.
So an adjustable rate mortgage is just that you're fixed for a certain period of time, usually 5, 7, or 10 years with that initial rates. And then after that, it has a subject to change at whatever the market is down the road. Before taking that risk of 5, 7, or 10-year fixed period, you can get a lower interest rate than what I can guarantee you for 30 years. So for 30 years, you might get that 7.5 for this, let's say, 7-year arm. I may give you 6.75%. So I'm getting a little bit of a savings, but it's only guaranteed for the first 7 years. If you're going to be in that house for 7 years or less, cool, you're getting a bit of a lower interest rate without taking on that 30-year fix. But yeah, people.
So can you, on that same house, can you like get that arm again? For a period of time? Or once it
Depends on what market rates are at the end of that 7 years. You can get another one.
I know it won't be at the same rate, but
Correct.
um,
You can refinance.
if it could still be lower than that 30-year.
Yeah, an arm is always going to be, or adjustable rate mortgage is always going to be lower than a 30-year fixed conventional.
I just closed on a home, this week, actually, and, it's an investment property, and for the first 6 months, I only pay just the interest. And after that, of course, I pay the principal and interest. And the principal and interest remains the same pretty much for the next 36 months, and then there's basically a balloon payment. And that balloon payment is like the overall grand scheme of what is owed on that particular home. Well, obviously, I intend to sell it before that time ever actually comes. And so that's the benefit of, taking advantage of certain things like that. Okay. I'm only paying for the interest rate, of course, for the first 6 months. That's the time frame in which I intend to go ahead and renovate it and everything else. Renovate it, build that value up in that home, of course, and then sell it, take out the value of it in order to utilize those funds to hopefully do it again,
And those are commercial loans, and like on investment property, doesn't apply like everyday house.
Right. You'll also want to compare, again, your discount points and your origination points. We talked about the discount points being 1% of the loan amount. Origination points are the same, okay? They're also going to be 1% of that actual loan amount. And when you're comparing these things, of course, these are the things that you want to talk to your lenders about, okay? And again, I try to utilize a uniform team because this team is knowledgeable. This team is, ethical, and they're not trying to get over on you or anything like that at all. All right. And even if you do decide to walk away with things like, hey, we want what's best for you. All right. It may not be what's best for you.
You pre-qualify with me first, go out, shop a couple of other lenders, send me all of their loan estimates, and I'll break them down for you. Hey, this one is better than this one, or hey, I'm the best option because of yada, yada. Give me those options to look at your loan estimates. You don't want a loan estimate, of course, from every lender. If a lender doesn't give you a loan estimate, that's where it's at.
Additionally, if you go back to a lender and say, hey, well, you know what? I can do this for you instead. To me, at least, and I can be wrong, but that's a red flag to me because you could have done that from the start. You could have done that from the start. Like, I don't want to play this back and forth ping pong game or anything like that with you. And that I can do this for you can also just be that rate drop. You went to this person, last week, you come back to them this week, and they're saying they're doing you a favor. It's not really a favor. This is basically what the mortgage is actually doing right now. Okay.
Yeah, sometimes I will have to get cutthroat and another lender, and I will do that to win the business. That was for a repeat client, though.
Okay.
Yeah.
But yeah, get with the lender that you can actually communicate with. Personally, I don't necessarily care for the whole aspect of like, just tell them to fill out my loan application. I want you to really talk to the individual, have a conversation with this person, don't just sit behind a desk or anything like that, sit behind a keyboard and things like that. Have a conversation, see who communicates best with you, right?
Who fits your personality.
Right. And as well as you want to compare your down payments. And typically that's going to be pretty standard, okay? Depending on the type of loan that you get, okay? So the process in itself, of course, when you're buying a home, you want to go ahead and, of course, find a unicorn team that you can work with and then start your pre-qualification process. Pre-qualification and pre-approval are two different things, okay? Qualification is really just going to be based on, what your income is, what your debts are, and things like that. An approval process is going to go through the down and dirty aspect of things, getting into, more details of what your situation actually is, okay? But once you've found this unicorn team and you've gotten pre-approved, of course, you want to gather all of your documentation up. The things that you're going to need in order to get pre-approved for a loan are the following. You're going to need your pay stubs, okay, to verify your income, all right? You're gonna need your pay stubs to verify your income. You're also gonna need 2 years tax returns, your W-2s. Or if you're independent, if you work for yourself, of course, your 1099s, okay? You're gonna need bank statements from at least the past 2 to 3 months, okay? In order to verify the income. You're also gonna need some employment documentation, okay? Now, is there anybody in here that works for themselves? Okay, good. Well,
Anybody?
because working for yourself can be a little bit, more tedious process, there are gonna be things that, you're gonna have to kind of go through a little differently, okay? And mainly because most times when you work for yourself, you're trying to write off as much taxes as possible, right? You're trying to write off those taxes, and when you write off those taxes, let's just say, for instance, you made 100,000 this year, but you wrote off, 70,000 of it, right? Which you can, but on file, I'm basically make $30,000 a year. So what am I gonna qualify for now?
Unless you
Right.
have a tax strategist that does it for you strategically.
Exactly. And you're gonna need verification of any debts and any income, of course, as well as assets, okay? So anything that you've invested in, stocks, bonds, anything like that, of course, you'll need that information, okay? You all have that? Okay, cool.
Biggest thing is like W-2s. Please keep track of your W-2s. Ain't seen a W-2 within the last 2 years. If you've worked there the last 2 years, please have it ready.
And typically, if you go to file your taxes and things like that, most people will give you a digital copy. I'm pretty sure you all.
We actually don't want that. We want the original copy from the employer.
Okay, okay, cool. Well, all right.
Even if it is a digital.
Exactly. Well, no, from ADP is cool, but it's like H&R Block will give you another generated copy of that. No, we don't want H&R Block's generated copy. I want it from the employer.
There is a thing called loan fraud. People
People will try to give
try it,
you
yeah.
taxes that have not been filed with the IRS, but they've been prepared. So you can prepare your taxes, but what the IRS actually gets, that's what I have to go off of. And so to verify that, there's a thing called tax transcripts, which is what we request from the IRS to see what they actually received. If it doesn't match what you gave me as you're prepared, that's mortgage fraud, and I'm turning you in. Ain't nobody got time for that.
And we ain't trying to go, or lose our careers and things like that.
No, it's just the buyer, it's just you. Because, yeah.
Once your actual offer is accepted, when you found a home that you're like, hey, Langston, I want to write an offer for this particular home. Your offer is actually accepted, okay? Once your offer is accepted, at that point in time, of course, you will formally begin that application process, okay? So you're submitting all of your information to that lender. Where I am, of course, submitting the actual, the accepted agreement and things like that, so that he then knows what the actual loan terms are, if you negotiated any closing costs or anything like that in it, so that they can take all of that stuff off of it, okay? You're gonna have a signed application along with the disclosures, and your loan advisor will then need a copy of the purchase and sale agreement, of course, which is the actual offer itself, okay? Once the offer is submitted and this information is submitted, of course, your lender is then going to send you the following documents within the first 3 days. They're gonna send you your loan estimates so that you know approximately how much, you're gonna have to pay for your mortgage, okay? And they're also going to send you a home loan toolkit, which you discussed a little earlier, Coach. So this is going to be basically a booklet that is going to detail the steps that a consumer needs in order to get the best mortgage that is for that individual situation, okay? Now, we discussed a little earlier, can you make this process move a little faster? Can, if you get with a uniform team, okay? And you have, you know, excuse the expression, but you have your shit together, okay? If you have your stuff together, of course, then yes, this process can move a lot faster. There are gonna be documentations for you to sign and things as well. If you don't sign it, we can't really move forward, okay? We can't move forward until, you know, you take the steps and things like that that are needed and necessary of you, okay? But in general, the process does take roughly about 30 to 45 days. But once that happens, of course, you know, you're approved. Your lender is gonna forward you their final decision on, you know, your personal situation, of course. And in certain circumstances, your loan application may be declined if you do certain things, right? So there are 10 commandments that I have, of course, as to like things not to do when you're buying a home, all right? Don't max out any credit cards. Don't go out and buy, you know, a new vehicle or things like that. Always pay your cards and things like that all the time, because all of these things can now affect your DTI. And if it affects your DTI just even a little bit, of course, if you're already at the max of that thing, you may get knocked out of the whole entire home purchase, okay? So please, please, please make sure that you don't do anything that is going to be detrimental towards your home purchase, okay? You just have a 30 to 45 days to discipline yourself, okay? Don't go out and buy new furniture, all right? Don't go out and buy new appliances and things like that because you feel like you're gonna close like next week and things like that. Just wait, all right? Wait it out. You're still gonna be able to get these things. You're still gonna be able to get that vehicle and stuff like that. But the one thing that you will not be able to do is get this house if you purchase this vehicle beforehand, because it's gonna affect your DTI. And DTI is what? That's income. Good deal. All right. And finally, you have to take care of certain contingencies, okay? Or I can take care of certain contingencies for you. Those contingencies can be the appraisal. Now, the appraisal is, you have contingencies like your appraisal, your home inspection, things like that. Now, an appraisal and a home inspection, two completely different things, okay? Now, I will say this, that apparently, according to Forbes and a couple other magazines and things, real estate or realtors are one of the most untrusted professions in the nation. I personally don't know as to why. But, you know, documented that it's one of the most untrusted professions. And I really just think that that's just due to, and I don't want this to sound derogatory, but I just want it to be taken as the definition of it, ignorance, okay? It's just a lack of knowledge. I personally think that it's just ignorance. Now, don't get me wrong, there are a lot of ignorant realtors, okay? There are a lot of ignorant professionals that don't know what they're doing and things as well. But there are so many steps and processes and things like that to protect you, the consumer, throughout this entire process. And one of those things is going to be your appraisal, okay? So technically speaking, unless you're paying cash for a home, you know, you technically can't overpay for a home, okay? You just really can't overpay for the price of a home, because that loan amount, of course, has to be like, basically, he's the lender, let's just say that he has all this money in his pocket, okay? He's giving it to you as a loan with interest to pay back, you know, in 30 years, all right? Now, I doubt that anybody in this room is going to give, you know, let's just say me, you know, hey, April, you got $500 I can borrow until like the end of the month. Like, I'll pay you back just that $500. Probably no, because technically speaking, you're losing money, you know? You're losing money, even though it's the same amount, but that money, of course, has value. It holds value because the world changes on a daily basis, right? And what we're going through right now, of course, is, you know, we've been stepping into recession. We've been stepping into a recession. I'm not sure if we're fully into a recession or not. We've been saying it for quite a while now, but I mean, quite frankly, you know, prices of everything have increased. Yeah, it definitely feels like it. Prices of everything have increased. What hasn't increased is, you know, income. You know, income still hasn't really increased in order to justify these things. So your income is just $500, right? You give me this $500 right now, and the price of milk goes up, you know, tomorrow, whatever, you lost some, you know, cents off of this $500. So So you're gonna charge me some equity. All right, cool. How about I pay you back, let's call it $550 or whatever at the end of this month. You may accept something like that, okay? And it's the same with, a lender or so. Now, even though it isn't his lane, but, of course, the institution that he works with, works for, whatever it may be, they're loaning you these funds, okay? Now, those funds are going to be verified to say, okay, hey, you know what, you're buying this particular asset right here. I need to make sure that this asset is worth what it's worth, okay? So if you made an offer of $200,000 on this home, I need to know that it's worth $200,000, okay? And so this third party, which is called an appraiser, is going to come in and verify that it's worth that $200,000. And if it's not, then, we have to renegotiate some things. And most times it's going to be on the seller to renegotiate. It doesn't mean that they have to sell you that home, let's say it appraised for $190,000. It doesn't mean that they have to sell you that home, okay? They can choose not to. But in most cases, it can be worked out because at the end of the day, even if they try to sell their home, to another individual during that same time frame, some appraisals stick, okay? FHA appraisals basically stick. So you went out and tried to buy their home this month and they didn't work it out to where they dropped the price, or something like that, of course, and then you go out to try to buy the home with the same FHA, hey, it's still worth $190,000, all right? So it's to the advantage of the seller to just go ahead and work it out or just decide to not sell at all, okay? But needless to say, I can't do anything in that process to cheat you of any funds. And I am personally the first person that generally starts the process and the last person to get paid, okay? Because I can't get paid until everything is documented, signed, and agreed upon. Even if you close on the loan itself, of course, we have certain documentation, things like that, that needs to be signed and documented before I can actually get paid on anything, okay? So technically, I can't cheat you out of anything, okay? But you definitely want to make sure that you have an appraisal done, okay? And if you're buying a home with any type of loan, then it's likely going to be done anyway. Your out-of-pocket expenses when you're buying a home are going to be the following. You're going to have your appraisal, which, in some cases can be worked into the loan amount and things like that. Sometimes, somebody will kind of work it into the loan and things. But your appraisal is generally going to be somewhere in between, let's call it about $450 to about $600, okay? You're going to also have your home inspection, okay? And this is a contingency as well. Do you have to have a home inspection? No. Is it wise to have a home inspection? Absolutely, okay? Absolutely, it is wise to have a home inspection. Depending on the size of the home, your home inspection is generally going to be roughly about $350 to about $500, okay? And these are funds that are due before closing, okay? These are out-of-pocket expenses from you, the buyer. Don't cross hands with me or anything like that. You have to pay the people that are servicing you at that time. The appraisal funds are gonna go towards that lender. The lender is then gonna pay the appraisal, okay? The home inspection funds are gonna go directly to that home inspector. A home inspector, I look at as a general doctor, okay? Hopefully, you go to see that general doctor at least once a year, right? We don't. Dang.
Oh, yeah.
Come on now. We go see that general doctor at least once a year, right? And we go see that general doctor and, he checks our major vitals, right? Checks our blood pressure, checks our reflexes and things like that, looks in our pupils and things like that, make sure that, everything is functioning properly, right? And sometimes, every now and then, like, you know what? Blood pressure is a little high, right? I'm not exactly sure as to what is wrong, but I want you to go see this specialist, right? He's gonna prescribe you to go see a specialist, but he can identify that something doesn't look right, right? Okay, that's a generalized doctor, general doctor, not specific on anything for the overall, for the most part. They probably can fix whatever's going on, but they're probably not insured in that area or anything like that. They're not specialized in that particular area. It's the same thing with a home inspector. The home inspector is going to go through that home, of course, and inspect that home from top to bottom, hopefully, okay? From top to bottom. And they're gonna identify certain things that, just don't look right within the home or don't function properly. This doesn't mean that the house is falling apart, okay? When you get your home inspection back, it's gonna be a booklet, it's gonna be about, somewhere between 30 and 50 pages or so. The major parts are gonna be your summary, pretty much. The summary is gonna identify the things that like, hey, red flag, yellow flag, green flag, or whatever it may be, okay? Again, they're going to identify, or what I call nitpick. Their job is to nitpick things, okay? They're gonna nitpick on everything that is in their home that they identify. This does not mean that everything in that home is something that you need to try to get repaired and fix and things, okay? It's not a brand new home, all right? And even if it is a brand new home, there's going to be something that is going to show up on their report, okay? You want to make sure that all the major vitals, all right, again, going back to being a doctor, are functioning and functioning properly, all right? Your foundation, your roof, your heating and air, your plumbing, things like that, your electrical, the things that are gonna cost you major dollars and stuff like that, you might wanna go ahead and like get negotiated from that agent to agent to see, hey, how can we work this thing out, okay? If you go in and start trying to nitpick the same way that the the inspector tried to nitpick, seller probably gonna look at the list and like, nope, I'm not doing it. Not doing it, not doing it at all. And you just kind of talk yourself out of a home that more than likely could be some DIY type stuff, okay? I had a buyer one time before, like there was some missing electrical plates and things like that. They put all of those things on. I'm like, we don't need, nope, I want to do it. All right. Well, guess what? Seller decided to like say, no, I'm not doing any of this stuff. And the buyer, of course, had cold feet from the start, decided like it's not for her, and essentially that's what it is. It's cold feet. It's cold feet. You're trying to walk into something perfect and it's just not going to happen. You want to get about 80% of the things that you want in a home. Okay? You're not going to get everything that you want in a home unless you have the funds to custom build that home, all right, from start to bottom. And even then, it's going to be difficult to get everything that you want because you may not be able to build on the land that you can afford or whatever it may be, okay? But if you can get 80% of what you want in the home, it's time to go ahead and put it off, okay? And by all means, once you're out looking at homes, okay, don't go through that home and like, what did they do with this? Why did they put this up? And what's wrong with the couch and stuff? Like, are we looking at the house or are we looking at, that personal items? If you don't like the house, just say that. Let's move on. They don't want to spend, 30 minutes, an hour and stuff like that in this house. If you can identify, nope, I don't like the neighborhood. Cool, let's go. Let's go. Let's move on. All right. I like buyers like that. Buyers that are intentional, know what they want, of course, and like, they're intentional with their time and things, okay? So you want to take care of those contingencies and things, okay? And then one of the final things, of course, is you want to take care of home insurance. So we have Tony here, of course, and she's going to discuss insurances with you all, okay? I promise you I was not. All right.
My name is Tony Frazier. I've been an insurance agent for 26 years. I had my own Frazier Insurance Agency with my uncle partner, and he started the business in 1984. I'll try to do this fast because I know insurance, everyone's like, okay, check out, I'm gone. But a lot of what I want to have to tell you is really important, okay? So now if that wasn't enough on all the things that you have to do to find a house and buy a house, then you have to insure the house. So you're gonna have to get past me, you're gonna have to get past the companies. And insurance or the mortgage and lenders, they use your credit score. They wanna look at your credit score. And then I'm gonna use this so I can make sure how it works. They use insurance scores to determine how likely you are to pay the loan. Be able to pay the loan and make payments on the loan. Insurance scores are used to determine how likely you are to file a claim. Because they find that it has determined, and the Federal Trade Commission has determined that the credit report factors correlate closely with the likelihood of filing insurance claims. But the idea is that people who manage their credit and finances well are likely to maintain their homes and their vehicles well. It's a pride of ownership that you have. And so that's why they use, it's a credit-based insurance scoring. And so the same with your loan, the better your insurance score, the better your insurance premium is going to be. The lower your insurance score, the higher your insurance premium is going to be because you're not going to get the discounts and things that you, could be entitled to. So, and, you know, when you approach me, when Langston or someone calls and says, hey, I've got this individual buying, I'd like, I'm gonna send them to you, I'd like to get a quote on home. The first things that I have to know, are the basic information. I need to know your information, again, because I'm gonna have to look at your insurance score is gonna matter. I've got to know your claim history. If you've owned or rented before, I have to know if you've had any claims, I gotta know about the house. I mean, how big is it? I'm gonna need the square footage of it. I'm gonna need the construction of it. I'm gonna need the foundation of it. I'm gonna need to know the updates on it. Your mechanicals, the age of the roof, that's huge. I gotta know if you have a lot of trees in your yard now. I have to know, if they, like your mechanicals, like your electrical. Of course, that's very important to an insurance company because they want to make sure that your electrical is up to code and that we're not going to be paying a fire claim. Because those things can happen. There's history. Some companies look at your history as far as claims, but then they also look at the history of the house you're buying if there's been a lot of claims. Because why? Is it just been because you had a storm or, a tornado or hail or whatever? Or did you have a water, which water's huge? And so they're looking at those things. And so I'm gonna ask you a lot of questions, I'm a certified insurance counselor. That means not only he talks about being a realtor, I am an insurance agent with a designation of a certified insurance counselor, which means I'm really digging in to make sure you understand the coverage, make sure you understand what you're buying, and make sure you know if you choose not to have one coverage over another, what that could mean for you. Do you want a policy that is like me, a coverage policy that's very strong? And then if you have a claim, you're not going to be nitpicked for the little bitty things. Or do you want to, just sometimes, it's a real thing. Cost is a huge factor, especially now. And with my policies, and when you go in on the DTI, the debt to income, a lot of times the policy that I want to sell you is going to be a very, based on our conversations and what we decide, a very robust policy on my experience on what type of claims can be paid and what your costs. If you're buying an older home, like anything less than, 2010 or 5, especially if you're getting in, the 60s, 70s, 80s, those things, and depending on where you're buying it, Sherwood, for instance, has their code enforcement is crazy. They change their ordinance all the time. And so there's certain coverages like a code, ordinance or laws, what it's called. If you don't have that coverage on the policy, which not every agent offers it, I see it a lot, it's missing. But if you don't have that coverage and you have a claim, then you're going to end up paying the difference between bringing yourself to code and what the insurance company pays. It's not the insurance company's fault. They're paying what you bought. And that's what a lot of people don't understand. They're paying what you bought. And so that's my job, is to try to work with you to see, what you're gonna do. Roofs. We gotta know the age of the roof. I can't guess. I can't guess on electrical. I can't guess on roofs. I can't guess on plumbing. I cannot guess on any of those things. So that's why an inspection report is so important. Because if my job wasn't hard enough, now since we're coming into the storms and everything that's happened over the last couple of years, there's been insurance companies that have 2 that I know of in Arkansas have gone out of business. Gone out. The insurance department took them over. They've got, time to, replace those policies. They got 90 days and they're done. I'm not ever going to put one of my clients in that position where I have to worry about that the insurance company is going to be able to pay. So that's also my job. It's my job to protect the insurance company and make sure that an inspection report is done. Make sure that everything is up to date. Because 2 of the companies I work with are now wanting inspection reports. No, they don't care about the appraisal. They want the report. They want to know that the electrical is in good condition. They want to know that the mechanicals, we call all those things mechanicals. They want to know that they're in good condition. They want to know that the roof is in good condition. That, because, you know, if you, and it goes more to maintenance, your policies, like if you're required to maintain your policy. And a lot of claims that are paid by the insurance company are due to a failure of maintaining. A lot of you don't even think about it. You know, you don't even think about if you have a tree that drops a lot of limbs or not limbs, but, leaves and you get moss or whatever, it tarnishes the integrity of that roof, which is gonna lead to, it's gonna make it deteriorate faster than what it would, and could increase the risk of leaks. And so they are, you know, they're really looking, they have drones, they have aerials, they do all of these things now, and they can come in and see what it looks like. And that's the biggest thing I'm saying. Trees are big right now. And so if you have any trees close to your house, any trees, limbs over, you know, over your home, you know, I'll write the policy, and then they'll come out and inspect, because they're all inspecting now. They didn't used to have to do that. They used to, you know, start doing aerial. No, they're all inspecting. You got trees, canopy over your house. If there's any of them close touching, I don't want to write you a policy and then you get a notice and say, hey, we're canceling your policy unless you pay all of this money to fix all of these problems. So do the inspection, you know, on the very beginning, you know, these things are have to be taken care
Quick question. So those things that you were saying, you needed to write the policies, so you find the majority or all of those things in the inspection report? Or
of.
where else would you get that?
Well, the inspection report is gonna deal with all the mechanicals, it's gonna deal with the age. Like, you know, and sometimes this information is hard to get because you gotta get it from the seller. And the seller has to disclose all of this. And some of these things I can pick up when I run a property loss report. That's part of my underwriting. And I'll pick up if there's been any claims filed, and then I can come back and say, hey, we've had some claims filed, we're gonna need some information about that. If it's water, if it's a hail or something that's large enough, I'm gonna know it probably was a storm, a tornado, hail, something, because they'll code the claim, they'll have a name for it. And then I can go back and, hey, we gotta confirm that they actually did the work replacing that roof instead of putting the money in their pocket, because that also is a thing that happens, you know, people don't fix issues.
So that's on the burden of the buyer working with the.
Well, the
realtor,
seller's supposed to disclose. If I run a report and I say, hey, I have a claim, then I'm gonna go back and they're gonna say, excuse me, you said you didn't have any claims on this property, but you owned it, and here's, you know, this money was paid out, so. You know, because I'm gonna tell my person I'm working with that there was a claim. And
Now,
so,
to that note, in the state of Arkansas, you don't have to disclose. You don't have to write a property disclosure or anything like that in the state of Arkansas.
you know,
You're not required to. But in most cases, people do.
Yeah.
There are some cases in which, you know, particularly if it's a investment property or something like that, the homeowner may live in California, he's never ever visited the home or anything like that, he doesn't know what's going on, he or she doesn't know what's going on with the home. They likely don't know when certain things were replaced or fixed, or, you know, they probably bought it as it was and things like that, and they weren't given that information thing. So they don't have to disclose this information, but, you know, most people are pretty, you know, I would like to say honest in disclosing information.
yeah. And to which on this middle saying, no, they don't have to disclose, but the insurance companies don't have to insure.
Right.
And they can cancel, and they will cancel. And unfortunately, in the 26 years I've been in business, I've never seen it so bad. That because of the amount of claims that they've come through that they're paying, you know, when you have companies going out of business, you want to, you know, they want to make sure that the risk that they're working with is going to be a good risk for them and a good risk for you, you know, because, and so that's, you know, part of what happens. And then, you know, they talked about the inflation guard and the equity here, the values. Our policies are designed, and what he was saying, the 3%, inflation guard used to be, you know, anywhere from 2 to 8% of your dwelling amount. It would increase every year to keep up with the costs and the value of your home. Because if you know, the value of your home goes up, then we want your insurance value to go up as well. So, and that brings me to the next point. So you're buying a house and it's a 2,000 square foot house. and you're paying, what would that cost you right now, about 300,000? It's gonna cost you about 300,000 for a 2,000 square foot house. And you're thinking, okay, well, my insurance on it, I'm probably gonna, about $350,000 to replace my home. Maybe what you're buying it for and what I'm gonna insure it for are two different things. And that's where a lot of people don't understand. The cost to replace is different than what market says you can buy it for. And so I'm gonna do a calculator, I'm gonna take your, so that's why I need to know your square footage, I need to go to construction, I need to go to, what's the foundation and those kind of things, and then that will come up with what the value, what the insurance value is if you have a total loss and your home has to be replaced. Unfortunately, there's not any loan officers that are going to allow you to have a homeowner policy that does not include replacement costs.
As DJ Khaled says, yesterday's price is not what?
Price.
Today's price.
Right.
All right.
Right. And so, because, and in fact, they ask us, oftentimes, I mean, my insurance is generally, well, it's funny I say that, when when people were fighting over homes and coming and paying, it was the seller market and people were going over asking, for so much, then that was the only time in my history that I've ever not been able to get the replacement costs, sometimes to what the loan amount is. Because I'm like, just because they want to pay, way more than what the house is, because of the market that we're in, I can't insure it for that. Because it's not going to cost that to rebuild it. So that was the only time in my history. We've come back down on that now. I've seen my numbers changing, but that happens. So I'll do those factors, and I'm going to talk to you about what your deductible tolerances are. A lot of people, they want these low deductibles. I wouldn't suggest filing claims for faults for small things. Because they'll cancel you. You get too many claims in a period of time, and two is one weather and one not weather right now, they will cancel you in a 3-year period. So my goal is to, that's how bad it's getting. And I'm an independent, so I work with a lot of different insurance companies. Captives have one. They have one company to work with. So setting the deductible at a tolerance at a level that Langston, how long ago did we meet? Was it over 15?
Yeah.
Through the Dave Ramsey program?
Yeah.
Yeah. I'm an endorsed agent through Dave Ramsey. I don't know if y'all ever heard of him. And so I worked with about 16, 17 years. We've worked with folks on how to, you work the steps, you have money in an emergency fund, and then you start building up your emergent, they want you to have, $1,000 in the bank, and then you follow the steps until you can at least put in, 6 months of your income, to cover your main bills and snowball your debt and how to get out of debt. So I work with people. And so, you need to try to put money aside when you can so that you can have a higher deductible and what your risk tolerance is, because you don't want to file claims. And so that's what I have to do, with someone. I say, okay. And now a lot of companies are setting the deductible at $2,500. They're saying we want a $2,500 deductible, or we're not going to write the business. And I'm like, we've gone from a 15 to a 25, but so I try to counsel folks on how we can do that. I know we're getting close. But anyway, this is called a deck page. This is the homeowner policy when it comes out. And so when I'm quoting you and I'm going over all the different covers that I think is important for you, sometimes when you're trying to get that loan closed, we may have to scale back on what I want you to have, and let's make sure we have a good policy for you. And then we're going to revisit that and make sure you have everything that you need, because especially right now, it's hard, with what some of the things that happen in the insurance industry. So basically what's going to happen is he's going to send you to me. I'm going to ask you a bunch of questions. If you have an auto policy, I want you to let me bundle it or quote bundling it, because not doing that throws out about 4 of my companies because they're requiring the bundle. They're not gonna do a home only right now. I've got so much good, positive information for y'all. I'm so sorry, but this is where the I'm real. And this is where the insurance industry is right now. So if I'm gonna quote someone, I'm gonna work on the home, I'm gonna ask you to send me your auto information as well. I'm gonna see how it looks and see if it makes sense for you. If it doesn't, I have, alternative people that I could refer you to if I can't help you. That usually doesn't happen, but sometimes it does. And it takes me, so when that happens, I'm gonna need that information pretty quickly because working with 7 different companies that I'm quoting, it takes me some time. I can't just spit it out, really fast, because I have a stack of quote requests, coming in because everybody's wanting their stuff reviewed right now. I'm gonna give you my email address. It's Toni, Toni, at Frazier, Frazier, agency.com. And my website is www.frazieragency.com. And I'm gonna tell you the best way, one of what we've done is we've created through our website a quoting portal. And so if you go to my website, it'll say get quote now. And when you do that, you click the link and it starts walking you through, if you want home and auto, like a new home and auto, it's gonna start walking you through that. And then I'll get a notification that you did that. And then you can even, if we're doing a home quote, you can put the information that and then also if you're bringing your auto in with it from the bundle, then you can put your auto information in there on every driver in your household, every vehicle in your household that you own, accidents, tickets, it picks that stuff up. And then you can also upload your current coverage through an encrypted site so that I can look at your deck page. Because what you have now is really important in my rating with my other companies. They use that data. And so it's not only is it important, but I need to look at it. Much like everyone else in the industry, I need to know where you are. So I know where I suggest that you should go. Okay, so things that you might change in your current policy. So once we write this policy, once we do, if I can write your insurance and be your insurance agent, every year I'm going to evaluate your policies. I'm going to make sure that they're right. I'm going to make sure the company is being fair to you. I want to make sure you're getting all the discounts and things that you should get before I suggest doing quotes anywhere else. Because longevity right now with an insurance company is also very important. And so you get, your best ratings start kind of happen when you start renewing because they're going to give you like renewal credits and things. So, they going from company to company to company like that, it can hurt you, honestly. So but because I am an independent agent, if it comes to, they just get crazy, they were good today, bad tomorrow, then I generally have an option for you in that way. So, and 2, one of the reasons I wanted to show you this deck page, like on your home, because it goes through like your dwelling and all the other things that are included, all the optional coverages and things that are included. So it lets me know kind of where you are, when someone's asking a quote for me. One other thing that's important on the roofs, why I need to know roof age is it's a determining factor for insurance companies, because some of them have come out and said, if your roof is over a certain age, we won't do it. I don't want to put you in a position to where I put you with an insurance company that might have that requirement. And then they're going to come out and inspect, or they're going to want documentation. We can't provide it to them. They're going to say, you got 30 days to fix it, or we're going to cancel. So, part of my job is to walk you through these steps and make sure you understand what you have to do, to be a homeowner, and the risks, associated with that, because they're unfortunately, like in any industry that we've talked about, some folks will just write you a policy and then go on. That's not me, that'll never be me. I'm gonna make sure that, doing you a good job. Protect, because it is one of your, homeownership is your biggest asset, Julie, that you'll have. So,
What is the minimum age?
the homeowner,
Not
for a roof,
yes, where they won't qualify you.
some of them have gone to 10. Yeah.
The
10 years.
general lifespan of a roof is roughly, somewhere between 15 and 20.
Yeah.
Now.
And so, and what they've done, like to qualify for a company, that's not all insurance companies, a qualifier roof, if it's 10 years old, this company say, we're not doing it. This company says, okay, we will do it, but we're gonna start, we've introduced a loss settlement depreciation. So just to easy math, if your roof is 15 years old, they're doing a depreciation on it. To replace your roof, it's $10,000 and they put a 30% depreciation on it. Then they're gonna take $3,000 off that 10 minus your deductible, and that's gonna be what you get paid. So it's pretty important when you're buying the roof, make sure it's in good condition, because that can always be something you might be able to negotiate in with the with the seller. So.
And there are times in which, like, I have a situation right now, where the insurance company came out prior to the sellers listing it and decided that they were not going, or that the roof didn't have enough damage in order to justify, it being replaced. And it came up on a home inspection. I asked them then again to go ahead and, get a second, opinion on it. They did, and they determined yesterday that they would then replace the roof. So, buyer's gonna go walk into this home with a completely new roof, which would have, ultimately cost them roughly about 20,000, 25,000 or so on this particular home. So, it's always good to, again, have a unicorn team of things. And one of the many reasons above all that I like Tony, and I've worked with Tony for so long, is because she's an insurance broker and not just an insurance agent. And so, as he said a little earlier, she's able to compare multiple companies and not just one company to that, what products they have. So I like to say, instead of just comparing apples to apples, she's able to compare apples to oranges. State Farm can only give you State Farm rates. Allstate can only give you Allstate rates. Tony's able to, of course, give you multiple rates from multiple companies, of course, to see what's best fit for you. And if you don't have a need to buy a home or get on home insurance and quote right now, that's fine. You can still utilize Tony, of course, because she insures cars. She has all sort of life insurances and everything else, of course, that she works with. So, it's a one-stop shop right here. Okay.
I do that, yeah. I can do it all. And right now is, health insurance time, and I do, the marketplace is opening, I do that. And if you have any family members who are of Medicare age, I also do, I have enroll people into, the Medicare plans. So. The last thing I was gonna say on roofs, this is just kind of a deal. If the roof is bad, they're not gonna be able to sell that house. They're gonna have to do something with it because no insurance company is gonna pick it up. Okay? And so you don't wanna be the one that gets a hold of a maintenance issue on a roof, because you're gonna be the one that has to pay for it. If there is hail damage on the house, hail damage is based on when it occurred. So if you bought the house this, like say in January, but we didn't have a storm, we had a storm 6 months prior to that, that policy in place at the time it occurred is the one that's gonna pay. So that seller's insurance, it's, they had hail damage during that time, so that's awful line inspections. That's super important.
All right. So essentially what's next for you all, of course, is honestly get started. I know that we discussed a ton today. I don't want you to have analysis paralysis, okay? Because that's definitely a real thing. All right. Just get started. Trust the process. Trust the people that you're working with, of course, because the majority of everything we discussed today is gonna be taken care of for you. All you have to do is have your stuff together, okay? Just have the paperwork, the documentation, things like that in order for Jacob to do his job, of course. I need to know the information, of course, in order for Tony to do her job. And I just need you to decide in order for me to do my job, okay? Or for Chris to do his job, okay? Now, of course, everybody on this side of the room is part of your team, if you choose to come with us, of course. But again, once again, if you decide against, hey, it's completely fine. I want you to do what's best for you, okay? There's no ill feelings or anything like that towards it or anything like that at all. I want you to always do what is going to be in your best circumstance situation. So just pretty much have everything together, okay? Again, we are your team. So let's get there together. If there's anybody here today that would like to go ahead and start that process and apply for a loan, then Jacob will be in the back here, of course, in order to go ahead and get you pre-qualified. And we can start on this process all together, okay? So you have, we're done with our actual seminar, of course, but you just got started, of course. So again, start this process early. Please do go ahead and review your credit reports to make sure that there is nothing derogatory on there that isn't your fault. And if there is something derogatory on there, maybe you can dispute that thing as well, of course, and in order to get, those things taken off, and maybe, your credit score will see, some type of boost and things. But as Jacob said a little early, there is no quick, easy fix or anything like that to your credit score. I know we all know people on Facebook, of course, that are advertising that thing, okay? But there's no quick, easy fix to it, okay? And it doesn't cost you anything to actually do it. You can do it yourself, all right? There's enough information on the web, in order to get this process started and completed. So I would like to thank you all for your time today. Again, my name is Langston Carr, right here. Chris McGee, he is also a licensed realtor. DeAndre actually is he's already a father, but he's at home with his wife from maternity leave. They just had a baby girl about 2 days ago or so, of course. And then Klein back there in the back, of course, admin, helping things and support. Of course, Jacob Hall, your lender with Regions Bank, and Tony Frazier with Frazier. I'm sorry.
It is
Okay,
You gotta put that down.
call you all this time, of course, but Tony Frazier with Frazier Insurances, okay?
It's the email, it's the law, it's like,
Now this course, hopefully was, you found some, benefit, to this particular course here. And it was absolutely free to you all. If you all do not mind, if you can scan this QR code here and, just leave a review, this goes to Google. It's one of the ways that I actually do get business, or Chris gets business and things like that, because people read Google reviews, all right? People read Google reviews. If you found it helpful, beneficial, or anything like that at all, even if you're not buying right now, just give your honest opinion. I do not mind if there is some, type of negative feedback or anything like that at all, because I want people to actually get, just the overall grand scheme of things. And if something was truly helpful to them, then like, hey, I like for everybody else to know so that they can also utilize those services, okay? And last but not least, there is a questionnaire that is inside of each of your forms. And that is for feedback for today's actual seminar, workshop itself, okay? This is honestly my first workshop in quite a few years. So, there's some things I need to brush up on, of course. Did a different type of workshop this time around instead of like, hey, what to look for in a home and things like that, because for the most part, you're here to see how you qualify. I don't think you actually need help in trying to actually find the home itself. We all have these things in our pockets we call phones, and most likely we're swiping left and right just like we do, Instagram or, TikTok or anything like that in order to discover what it is that we actually like. I can't determine what you like, right? But I can help you to negotiate some of those things in the home and things, of course. Now, I'm not a magician, all right? I'm not a magician by any means, and I cannot turn water to wine, all right? So, I want you to have some realistic expectations once you leave here today, okay? But if you would, fill out that questionnaire, I greatly appreciate it. And, last but not least, and Chris, if you go ahead and give us some music, Klein, do you have that, thing for the, door process? The, carousel situation? So we got the door prizes for you all, okay? All right, so I guess I'll ask a couple of questions, huh? There are 3 more left. What? It is basically everybody in the room. He's like, hey, I'm open liquor today. You get a prize. You get a prize. You get a prize, bro. Cool. All right, but I'm gonna ask a couple questions then, though. We already know what DTI stands for, right? All right, cool. All right, first person that can tell me what PMI stands for.
Private mortgage insurance.
There we go.
There we go.
All right, all right, all right. Got a security cam for you, okay?
Oh, dang, no.
Yeah, what do you get?
All right, let's see here. Jacob, you got a question?
The tricky one, I think we just went over everything. That's too easy. What was the housing ratio for rural development? We calculated 33% on the worksheet, but I said rural development has an even lower one at.
I know.
It was 6.
That's why.
I was on it.
What was the total? Yeah, 29%.
But I don't win.
How about percentage there?
How many years does it take of you not owning a home for you to be considered a first-time homebuyer again?
2.
3.
She got it.
Yeah, but like, look, you already won, and I would do right the same thing. How about this? On a conventional loan, if you are a first-time buyer, and you have a good credit score, what is the lowest percentage that you would have to put down?
Conventional first-time homebuyer.
It was 0,
You
right?
said what?
3.
You said what? Avery?
3.
All right, you win. You get a prize. You get a prize. You get a prize.
Urban development.
All right. And the last thing we have, I guess, yeah, everybody answered that. So I guess Devon, Tiffany. Let's see here. Chris, you ask.
Let's see.
At what age can insurance companies decline your roof?
It was after 10 years, right?
You got it.
You get a prize, you get a prize, you get a prize. All right. So once again, I would like to thank you all, and we would like to thank you all, of course, for coming out today. If you like any more food, of course, please, by all means, take it along with you all. And if you found today beneficial, once again, scan this QR code things, of course, go ahead and leave a review. It's greatly appreciated. And last but not least, hey, if you got friends, family, anything like that at all that would be interested in this process, please, 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 by all means, let them know that you found it beneficial and so that they can come out for the next time. Intend on doing another one in December, so, okay? All right. And again, if anybody wants to go ahead and get started on that loan process, you know, let's let them know. And,
Run your credit. Ready for them to run your credit. Of course, I'm available if you have questions too.
go ahead and rip that Band-Aid, all right? Rip the plastic off of that brand new. Oh.
Thank you.
Could you write numbers?
We got.
Good.
I can tell I'm gonna beat Alabama.
Game over?
What was it, 24?
I always say they play teams that they supposed to play good, pretty good, and then teams they supposed to beat, like, it's like, what in the world?
Thanks for inviting me. I've been picture of somebody today. Oh. Oh, wait. Thank you. Wait, no, move, and you better tell your daughter don't take this, because she took the other one. I don't know, because I haven't looked around. Will you let me, I have not looked around at the houses, so I don't know what the average price is. They don't know what
And you don't know what you want for a desire price. Say my account, you can't ask my question, yeah, 1250.
That's not, nothing.
But we're gonna say,
Which was, so it's more than, I don't know what it is.
okay, so.
Wait, you have to work on your. But I don't know. So, you let, like I said.
Is. Wow.
No, it goes hand in hand with. No, we did not need to be able to. You understand, have you been pre-approved for more? And yes, what amount have you been pre-approved for? Two or three go ahead, and it has nothing to do with it. And when you board. Just the length on.
Thank you.
Mike, Chris, quick question. Carl, can I see that again, please? So, Chris, quick question. So for me to have a desired price range, do I have to be pre-approved? Right. With the approval, we're gonna say, what the price range is. Okay, okay, that's what I. There you go. And. That's our house over at night. Oh, that's why I see it, dude. Oh, yeah, you know.
Quarterback, so. Dang.
Job, Chris. Man, I ain't even got that on my computer. I didn't download it on purpose. So when these kids be asking me to play, I'll be like, oh man, I ain't even got that. I ain't got the clean version.
See, what did that one little girl ask me to play FNL?
Yeah.
I'm like, Chris, what's FNL? Hell. You was like,
No.
you like, bro, you, I'm just, no, I have no idea. You like, I'm like, oh.
I'm
Oh.
not
So all y'all got out next week? Who all y'all got out next week?
It's the quarterback, the receivers, running back, Charlie, on our linebacker.
They had 2 starters there. Oh.
I told these, I said, man.
I coached a different game like that. I said, hey, y'all, I could have saved y'all. Yeah, I could have watched it online, but yeah, man, that quarterback from the league was terrible. Like, if they had a good quarterback, yeah, they would be.
Who was there? What color was there?
Cortez.
He was there?
Yeah, because he had a fresh twist.
Easy. We call him Easy E.
He had a fresh twist.
We call him Easy E.
Big coach with the beard.
Coach Bo.
It was about 4 more there.
So all of them probably was there.
One of y'all coaches at Kappa.
Yep.
And they left probably a little bit before halftime.
Oh, for real? Yeah. That's all they need to see.
Wasn't nothing to see. It's thing. Man, we'll get it together one day.
Man.
If not, we'll fool around and lose to y'all or.
Well, if y'all lose to us,
or maybe.
y'all lose to us, man, I'm coming to y'all house, right?
Hey, you don't know where we live in somewhere.
Yes, I do.
You don't know where you live in.
My sister live over there.
You used to live in this,
I
you
need
used
to-
to be living in.
I need glad. Appreciate it. I'm just being like, all right. I apologize for it running so long. Yeah, I kept looking at it, I'm like, God, this lasting a lot longer than a minute. And so those are people that you work extensively with.
Did you ever figure out who?
Oh. You said exclusively or no? Not necessarily. Well, not exclusively, but extensive.
For EK.
This is where y'all work together. Most often.
Last week.
Not necessarily. So I use Blake Peterson most of the times with loans and stuff like that.
The King
And
is in his second.
I use Jacob pretty often as well.
Not here.
Ultimately, it's up to the client to decide, who they want to use.
I want something tonight.
And so, depending on the situation and what's best for them.
I found out too already about the tickets.
It's up to who work with them. Jacob will tell you right now, like, I'm a little bougie. It may not fun well with, everybody and stuff, But what I love about Jacob is like, he's upfront and direct, even sugarcoating and stuff like that. I'm not trying to sell wolf tickets tonight, I want people to have some very realistic expectations. And I want to deal with people that are gonna be honest, so, yeah.
Having his finals and coming home.
Forgot to tell Mike.
All my sister was like,
I know he's not trying to run, but just so
no, she's like,
he could meet you
goes
face to face and
to go get him.
Chris and
Yeah, I went to
build some relationships with vendors and people that do insurance or use the name.
He had a different version of it. He just had surgery.
I thought y'all think y'all away from
wanted to do something, but I don't wanna do something, because I don't want them to look like one part, so I just need to. You can sit, but a dream can't help himself, just trying to reduce stress, but yeah, he not, because he been out.
Maybe I really do is.
And he just had surgery last.
Credit card bill.
Like I said,
It's not
this
that
is show support, just a friend, play for over you, that you don't got.
It's,
Shoot, I'm sure gonna, so, but that's, I think I still got it, you know. Yeah, I should. I think he texted me the other day or something.
make sure that you,
Or maybe I was looking
make sure useless, that's what it, you know what I'm saying, like it's useless.
We really need some sort of, I was telling you,
So I was like, okay, and then when I came, that's what y'all was just talking about.
And I ain't barbecuing, okay, it's really, you know, it's fun.
I know the process.
I think that's real, like.
It's one of those, it's one of those.
Cooking somebody.
Again, it could be overwhelming, and it will be overwhelming, because you're gonna allow it to be overwhelming. But you can also just trust the individuals and the team and stuff like that. You know, as long as you got your paperwork and stuff like that, man, majority of this is take care of.
Bad.
You know, not even personally.
I was just going home, we came back, had doctors 2-3 times.
This, and that, it's like,
And
you.
then,
It's like,
when we got ready at the end of the summer, we got.
You know, as long as you about the situation.
Atlanta, I'm like,
I,
just feel because.
Questions or anything like that?
I played.
Go ahead.
man, we have to see. We definitely something about that. You know, and like a lot of stuff that I really want to sit down with you, about. Answer it.
Figure out what it is.
And just, you know, like, maybe just more so with my, it
Free,
frees,
what they call
it
it?
was definitely like,
And if you see just people like, dang, boy, you gonna pick up all that weight? I
That
said,
freshman 50, huh?
like I knew it was working, it was really,
The nephew say food is good.
you know, so.
I mean, and, you know, respectfully, you looking at right. You know, and you got, you know, overall grand scheme of things and how it deals and past the boards. Yeah.
Right, you better get to a hot ready.
And I understand.
Frying and serving, like, what else you think?
When it come home,
Right.
you ain't gonna wanna do
I
nothing.
still right now, you know, as far as
He already had them.
personal place to stay, like,
That he said-
I don't know, yeah.
The way- the way he-
But like, I
his
want
bride,
that,
he-
you know,
And
over 2,000 square feet and stuff like that, like, so what's the going rush?
That's the best.
That's
He
one
said
course,
it's just
2,000 square foot
to
home?
get to them.
That's cool.
like 2,000 square feet.
What location?
We're trying to say, and this is probably.
And he was just blessed to get there.
I'll put, they gave it to the number eight.
But it ain't cheap, you know, whatever, $175 semester.
Man,
Let's call it 150 to 165 square foot. So
That's normal.
probably gonna be like about
Car,
You got,
you can't take it.
3.
My friend said, depending on where you park at on campus, so his friends, they got.
Multiply 160 times 2,000.
They're his age, they got, they mama loaded. She, and they glad, they asked money,
Okay.
she paid 1,500 for one kid to park, about 840, $1,000.
you get your bike, take your.
Yeah, she bought some that they put in their cars, now you're taking one car on campus.
On top of my head, in the
Free.
Josie area.
Well, it's the oldest who's been, she's gonna graduate in
I had
the
to-
twins, that's just in that.
Guess how I was saying about
Yeah, I can have some, y'all can share.
23.
Oh, we got shared, right? They got a car, they shared a car, and she got the.
And I'm just using.
They got a brand. She can build a house.
Where? The kids?
All three of them.
Stretch out some.
Figure out what's going on with my.
She owned kids.
No. Draw something, you know.
Okay, yeah, she paid.
Mhm. Then on top of her house. that she
So
built.
just say, if you want to stay
That's what I'm going to the game, or we gotta go to the game.
Right there somewhere, in that area, you probably gonna get no help. 20 to 135. Southwest, I was looking at about, 100 square feet. You know,
That's called weed right there.
Bryant area, probably live about 130 to 150. Wait, that Bryant area is cheaper than the Robinson area. Access. Access, what's still built around it and things like that. Off the land was cheaper and things like that. Trying to look at things like this. Areas build up, communities build up based on, access, basically. So even when, people settle in certain cities, of course, in America, most of the times when they, like the East Coast grew a lot quicker because people were coming from, Europe and, places like that, Africa and things like that. So first point they got to was East Coast, and then they started settling from there into the rest of the United States, but they settled primarily through water, So certain points on the water, like Little Rock, basically was an access point because of water. And so because things could be manufactured and moved out into these areas a lot quicker and things like that, they settled on, places that had easier access points and stuff. And so Little Rock, of course, is higher per square foot because it grew, faster than, places on the outskirts.
Okay. Even though Bryant is rapidly growing, Little Rock is still gonna cost more to live in than the mid Bryant area.
Yep.
Okay.
Yep. We'll talk more, bro.
Okay.
All right. Appreciate it.
No problem.
A lot about how much was left. It's a lot of people left. So I got, after he put it in these things, and then after they came in here, got it to go play, I thought it was left.
He makes the Uh, I'd rather use those calories for something to drink.
Alright, well, I'm going out.
Is it in a bottle or something? Yeah, I'm straight.
Huh?
I'm straight.
Okay.
Myself. Money, them,
Huh?
money.